assume they're both, and then you're looking at these things and saying, okay, well, like I don't want to hard close. Like if you were to hover between these two levels for 4 or 5 minutes, you'd probably be hard closing a 5-minute level there. So you'd probably be creating a new distribution candle that could create a new hold level moving up on the 5-minute. So that would be really bad, right? And then the move just goes down, loses its move from here, right? It loses its move from here. And yeah, you're probably just moving down, straight down off of that. So that's how I would manage it. I would manage it in terms of, while you're in this trade and in this scalp, I would be looking at what levels and time frames it creates. Because when you're on 1-minute time frames, like every minute that passes by ends up being, like there's only 3 1-minutes in a minute candle. So after you've closed your first candle, you may only be 1 more minute away because you may have already opened it 1 minute previous, or you may have already closed. Like 1 minute could end up being a 3 and a 5-minute candle. But on the 1-minute candles, like things are changing so fast that take this replayer tool off. Yeah, so that was the, I don't even know which one is a 15-minute level here. Oh, that's the stuff here. Okay. Oh, so you fell down quite a bit. Oh, wow. That was a decent trade then. Is this like 2%? Yeah, 2%. Wow, that was actually a pretty decent trade. And then you can see it goes after each level before it tries to break its move. So that's great. That's great because you know what? It gives you a very easy way to manage the trade. So that's how I would always look at any trade. Because I'm getting into hold levels that are polarity, you need to take these hold levels, right? You need to take these hold levels like this. You need to take these hold levels. I got to put this up here. I keep reaching up for it. You've got to take your hold level, assuming that's your polarity because it's laddering from here. And this is the hold level where you're entering short. You've got to take that and say, okay, if this was the final moment, what do we have to create now to protect that final moment? So then you create 3-minute levels, you create 5-minute levels, and if they hold over time and you create trends, and then they just end up holding and you create the bigger hold level for the next part of the move. Probably the exact same thing that happened here. You back target your level. If you have enough time to create whatever level in the future you need, just like right here, you would have created this with enough time, and that holds the move and tests it. This falls completely off the face of the earth, but this holds the move and tests it. Now you're somewhere up in the ladder off this range. I haven't looked today, but somewhere off the ladder of this range, some maybe type of reverse level here, something like this. I don't know. I something like what's in this candle here. I don't know. I haven't looked, but you always have to kind of use a 1-minute chart. Once you're in a trade like that, once you've entered a trade, you kind of have to say, okay, the first thing you do is you say, was this polarity or is this just some like middle of the range point? Right. And then that allows you to understand the trading range that you're in more by understanding what it's attacking. Because if this was the middle of the range somewhere and it's not a ladder point, then it might not be done its move. So, you know, creating a 15-minute hold level on this side here, like you created right here, might not be as important. Right. So like understanding what you're buying, what point you're buying on the chart, and then allowing that to create those levels is pretty key. Want to trade a simple level as a scalp, you get out as soon as it goes break ever again. I mean, the simple little scalps get out as soon as it goes to the break level. You can't really dictate a one criteria for where you get out, other than if you want, like, I think the healthier way to do this, the strategies videos that are coming out on Tuesday or Monday or whenever I can actually get them out, they're going to be really helpful, because I always go back to this. Every 10 scalps is a swing trade. A swing trade's definition is like an hour or longer. This was technically, now I think that's true. I don't actually know. It might be 15 minutes. It might be half an hour. I think a scalp trade is 0 to 60 minutes. And the literal definition of a swing trade is 1 to 12 hours, I believe. But in this case, this was technically a swing trade. Anything that lasts, I believe it's over an hour. Even if it's 4 hours, it might be 2. I don't know. I don't even know if there's a hard set definition. I just think everybody has kind of their own, you know, idea of what it means. Like, oh, I've been in this trade for a few days. It's a swing trade. Well, technically that might be a position trade, because I think 48 hours is the technical definition of a position trade. I think there's some people who say it's a day, some people who say it's 2, and some people who say it's 3. I think the technical definition is 2. So regardless of what the definitions are, like, first off, keep that in mind. Second off, if this was like 4 hours, even 4 hours, so you'd be at 20 This, if you were in it longer than this, then you could, if you consider that a swing trade, it could be a swing trade. More than just saying like the break level is what you have to go after, Triple, you have to kind of define if it makes more sense as a swing trade or a scalp trade, and if that scalp can develop into a swing trade. So when you're deciding what your target should be, I think the most important criteria is seeing like how big are the levels above holding you. So here you had a 5 minute, right? Let's mark that. You have a 5 minute holding you, and you just created a 15 minute hold level. So if you're in this and you're saying, I want to target here, you're saying, I want to target this break level, so I'm going to just exit slightly above it, like right here, maybe that's your target. I think that's a good target as an exit, unless you go back, you don't reach your target, you go back, you test this and you hold it down. So like in this moment here, I would use the 15 minute as my shield. I would use that as my shield to lock up profits. So if you started closing above it, I would say, well, 30% is not great, but we're running the risk of moving up. So I'll lock up profits around 20%, because by the time it breaks, it's not going to, like, you're going to be able to get out on the level. Alternatively, if it hits this level, tests and closes under it, then we might be creating the hourly, which would be all the way down here. So my next target would be like this. I need to create the hourly. So it's either going to stop just before the hourly is able to create, or it's going to. So my next target would be something like this right here, because I'd want to say, okay, it's going to hit the hourly and reject the creation of that. So that like every trade is going to be different. So then this trade is happening. You haven't hit your target yet. You hit your 15 minute level. At this point, I don't think it makes sense to take this break as a target. I think before hitting this 15 minute level, it made sense. After you hit it, you're confirming that you're holding that 15 minute level. What about a 4 hour? Where's the 4 hour on this sucker? 4 hours is way down there. So I think at this point now you have to adjust your target down closer to like the hourly time frame here. And then you can use like the 5 minute as your next kind of like shield or trigger if you want to say like, oh, if you start, you know, closing this, then you're going to want to get out of the trade. Obviously it's not going to be yet because it's holding the 15 still, so you need a little bit of time for this to come down and then reattack it. And then you can use your hold levels as well. So if that's the point that creates the hourly, you could go here and say, I want to exit target like slightly above this level, but realistically you could go greedier all the way down to here. During the move, you hit your 5 minute, you hit your backside, not quite. I think you're okay still. So that would have been like your exit there if you wanted to do that, because again, it's gonna go after the creation of this hourly to try to create it as a level, and it's going to reject that. So then you can roll your targets through based on what you're seeing, and then if you didn't take an exit, then you have your hourly right here, and you could use that as your shield, right? And it breaks up and over and smashes it, because that's what it's going to try to do, right? It's going to try to use this to create an hourly distribution level. And if it fails doing that like multiple times here, it's going to snap in the other direction. So you can see how, like, to say going after the break of a move is the right play. How that can't always be the right play, because your breaks and your holds and the targets are very dynamic. You may miss a target, create a 15 like we did at the very beginning of this move, miss your target, create a 15. The 15 gets tested, the target gets missed on the bottom side. So like the queue of events looks like this. Take this replayer tool back to here. Come on. The queue of events looks like this. We want to target the hourly break level. Right here. Okay. So our target to exit is maybe the creation of this level slightly above it, which is like right here, which I don't even think is really great. Let's just say you want to take the break level right here and exit slightly above it because you think that's going to reject. Okay, so like right here. Or you could use something like this right here. What could hold the level and ladder the move? Some type of origin from the past. I'm not saying it's here. I'm saying this looks like it's testing it. So you could use this here as the origin from the past. When it doesn't reach this target, your next queue of events is like, okay, is the 15 going to hold? Because you'd still be in this trade. You would have missed your exit. So you'd still be in this trade, and you'd either be triggering out to lock up more profits, right? Or you'd be saying, is this 15 minute going to hold? So you're getting out of the trade after that 15 minute there. But in this case, the 15 holds. But that wasn't the case 10 minutes ago, because 10 minutes ago, you're still trying to attack the break of the move. The attack of the break of the move failed, and it goes and back tests the 15, which now changes the architecture completely to like this one here. I'm not sure what the next candle looks like here. Yeah, now it changes it to this one here. And you've gone past your target. So now your target isn't even here at all. So while it might be your target now, in 10 minutes, it could change because it misses your target, confirms that a 15 is holding on the upside, and then goes after the larger hourly creation, which is down here. Because the 15-minute held, the next thing you're saying is, okay, now it has to create the hourly hold level, right? So then your targets are constantly evolving based on what's happening. And in this case, you can see exactly why this launches up so hard, because it is trying to create this hourly hold level based off of 15. Like, it's trying to build the architecture. It's trying to strengthen the architecture. It's trying to build that hourly level based off the 15s. It goes and it rejects it, which is perfectly fine. This is continuing the ladder here at this point. This is continuing the ladder. It moves down, tries to break it, and fails breaking it, therefore creating the hourly hold level on this side instead. And then it launches over that like crazy. So now you're in like an hourly to hourly scenario where you've got an hourly hold level here and you've got an hourly hold level here. But you can see exactly why it snaps up when it tries and attempts to break this hourly level. It tries once, it attacks it, it can't do it. It tries a second time and completely rejects that by creating its alternative 1 hour level. Like, this level rejected completely, but instead it created this level. So of course it's going to smash up through like out of its mind. This is kind of just like, common sense. If a hold level can't be created, like, you're going to just crush the other way, and then you're going to create that exact same hold level on the other side, right? So hopefully that makes sense. He said break even, not break level. That's okay. This is a really good explanation. Something we needed to go over anyways. Do I get out as soon as it goes break even? I would change that based on the I would change that based on the move. Just catching up on chat here. Are you saying even though it goes in negative in the initial trade, bad entry, I suppose? That's risk tolerance, right? So you get out as soon as it goes break even. You get out as soon as your shield is no longer holding the move. Shield in the move is something you define as the point that you don't want it to go past. In this trade, our entry is on the 15-minute, right? Our entry is on the trading view to not be so slow. So our entry here, like, you have to define a shield in the trade, and a shield is like what happens that can break the move. Like, you're attacking the 15, so what can support the continuation of this moving up? Well, if you start hard closing over your I'm just trying to speed my computer up, close as many programs as I can here. Got a million things open, After Effects, Adobe. You'd want to create something that says, oh, if I hard close over this, I should be out of this trade, right? And then, you could move even back here, and you could even say, oh, the backside, which I think is a little risky here, but if I hard close over this, I'd want to be out of the trade, right? Now it moves up a bit. Now it's like right here. If you hard close over this, you'd want to be out of the trade. Haven't hard closed yet. Now you have a trend. Now you can say, okay, we didn't hard close. Let me make a trend. So if you were to rewind this 1 minute, you would say, okay, I didn't hard close yet. I may hard close in a 1 minute candle here. I may hard close the next candle, which means I should get out of the trade because likely the trend is breaking. So this becomes the kind of your definition of whether you should stay or leave a trade. At this point here, if you entered right here and you saw this, your losses are so minimized that, like, it's really safe. It's really safe, and you'd have to constantly be wrong to really get hit hard here. And then at this point you'd say, okay, well, here's your next hold level. You can't really break over this, and then you'd go and you'd create your other architecture too. Like, you have a 3 minute right here. Like, this could hold the move, right? This could definitely hold the move. This is the 1 and the 3. Is it also the 5? No, the 5 is here. So you have a 1 and a 3 minute that can create what could be a hold level to support this move going up. So you have to create shields in a trade to say, like, I've entered here. What is the criteria right now on these 1 minute candles that are dictating whether this thing is moving up or down? Does that make sense? Makes a lot of sense. Yeah. You just have to create that shield, right? I'm a little confused on failure to create the hourly hold on the bottom side. I can go over it right now. This is really important for trade management. So this is not like by all means, Aaron, this is like a good question because we're creating trade management now for everybody. This is trade management, right? So let me make sure I understand your question here. Let's read through it. A little confused about the failure to create the hourly hold on the bottom side. Great. Let me go through that because I think this will help everybody anyway. So when you are trying to create a hold level, let's go and delete all this other noise that's in the way so we can just have a nice clean chart. We can delete this interior trend, everything. So you have to think of one step forward in the future. You have to think of what could be created. Imagine this, okay? This were to become an hourly hold level in the future. I'll mark this blue. If this were to become an hourly hold level in the future, well, indeed it would support a large move down and act as a point that could hold the trade, right? Just like if this were to create a 4 hour in the future here. Well, these surely are points that would act as major resistance in the future, just like this one does right here. This is a big 4 hour level. It acts as the reverse candidate for the move. And this one up here acts as a nice 4 hour level and so forth and so forth. Any hold level that's ever created is going to act as great support or resistance for a move. So they become targets. The creation of this moment becomes its own target because what the ideal scenario is that you go down here and you start to hard close under this, even if it's just around here. Enough time sat right here, and guess what you've created? You've created a hold level. So then you're going to go like this and you're going to dump, right? So the target becomes creating that level. So like ideally you'd want to be in your short from up here, not when you test back here, or you could be in your short there if you had already been here and you took, you know, whatever, maybe you took your profits on the attempt at this 4 hour. So a target in these markets becomes the creation of levels. Those become great targets. And then when you attack them, the question becomes, oh, okay, am I creating a level here or am I not creating a level, right? Am I going to create a hourly hold, or am I going to attempt to create that and reject it? Because the creation of this surely would mean that all these shorts here, like they're in a great position because now they could just exit when this breaks. So now they've got like a guaranteed profit lockup spot of what? Even if this broke, it's like, oh, I make minimum 1% on this, which can be a lot of money, by the way. Minimum 1%. I could just see if where this thing goes. Because once you get under this level, it acts as the perfect shield. It acts as the perfect shield going forward. So they become targets. So that's why you see something like this level here will become such a major attempt to break this move. It'll become such a glaring target because it's next on the list of what's important. Hold levels, ranges, levels that could be created. See how it acts as like the perfect level. If that holds, it means the 1 hour hold level could never have been created. It tried to, and it failed creating it. So it's already tried once to create this as a level. Okay, let's move forward in the charts now and see what happens when it actually tries a second time. Okay, what are you doing here? You're still technically laddering your move. You're still holding whatever 15-minute level here. I think this is also a 15-minute level, by the way. So whatever 15-minute level you're holding here, it attempts to create it, right? It attempts to create this as a hold level. It's right there in the moment. Trend holds it. So trend held it, meaning that in this moment, as long as trend holds, it can create this as its level. So that also becomes a target on the other side. It also becomes almost like an origin point for this thing. It almost becomes like an origin level. You see how it tests there, it falls back down to see if it can hold because it's just seeing which hold level is going to be established. Goes there, does break over it on the one, starts to ladder off that 1 minute break, moves up, creates it as a hold level. Jesus, this is slow. I got to refresh my trading view. So you can see how like the creation of levels becomes glaring targets on our charts. This is like a really key moment that people, it makes total sense. Again, I would love to say this is common sense, but it's not so common. But imagine creating a level and being in before it, right? Like I go back to that clip of myself when I said, you know, let the 4 hour create, let it linger and then let it dump. Me, like that whole, you know, whatever that famous clip where I called the bear market because there was a lot of stuff going on to a company that would say if this 4 hour gets created, like it's all gone. It's all gone. This whole chart is gone. And then it did. It just crashed to the ground, right? It crashed down to 29K. So creation of levels becomes a target. This is a really important part about managing trades and like trade management and managing how you're supposed to take this information and move it forward, right? Like managing trades, you have to be aware of what's happening, because if you saw this 1 hour level trying to be created off of 15-minute holds and it rejecting because trend is holding it up, well, it's time to get out of your trade and lock up as much profits as you can. So your targets, they scale, right? The move hits the greediest hold, it is set to move in the same direction later. Not always. You have to look at stuff like this. This is the deeper information. This is the stuff they don't teach you in school. What movie is that from? I don't remember, but that's yeah, it makes a lot of sense. Yes, 100%. Like monitoring hold levels as they're created shields. Yes. I see so much clearer with that explanation. Thanks, Cotton. You're welcome. But it makes total sense, right? God, that's my new favorite word. It makes total sense, right? Like imagine if you could get into the 4 hour level before it's created, before this 4 hour, like go back to any time frame on any chart, right? Go back to any time, like go here. If you're going to create such a strong level, imagine you're going to create this as a hold level. Start dissecting this part of the move. Let's get rid of this one. Let's get rid of this. Let's get rid of all this stuff on the chart that we don't need. You're going to create this as a level. Like imagine getting in on this hourly hold level to say that 4 hour could be created. Once this 4 hours created, God, go back in time frames even more. What do you have here? Do you have the 15-minute here? That leads it to here, 15-minute hold level. You go even greedier, 5-minute backside. Could you go front side? Oh, front side was the greediest, but that's really like hardcore. So you can see how this would have, like whatever had brought, if this is the creation of the 4 hour level, that's also going to be a target for it to break in the future, which just acts as polarity going forward because it was the creation of the 4 hour level, right? Almost think of it like an origin level. See how hard it tried to dump here and it couldn't quite do it, but it starts hard closing here. And when it hard closes, this thing is likely gone. I'm sure if you even went to a 1 minute candle, you'd have a lot of stuff going on that level. You just have like the constant battling of this level. Create the 4 hour there, try to hold it, lose the level, ladder down, create a ladder back up off of it, right? To say like, oh, this 4 hour level isn't going to create, you ladder off it, you create a trend like this. You create a trend like that. This has got a hold of the 4 hours creating. You go, you hold trend, you reject the 4 hour, you lose that backside test. Like it all makes total sense because you're just getting in like a better, more premium entry on the 4 hour instead of buying it when it bounces back later in the future. You're buying from like these moments up here and up here, and then if it creates, like that becomes the target. So when this 4 hours created, right, this is like a great target because it's the 5 minute level. It's the perfect entry. It's the 5 minute level that protects the whole thing. The 4 hours already been created. It tries to hold it, starts to lose it, creates its final trend, and then the rest is history. Probably just falls off the face of the earth here, right? Or we could just speed this thing up a little bit. Yeah. Just falls off the face of the earth because like you're buying the 4 hour level before it's created. Even moving up in here into the higher parts of the move. If you can get in before a level is created and then it creates, holy crap, you just created like the perfect trade. Like that's literally the perfect trade. Even right now, you have the hourly being created right here. So if you start to hard close this, I suppose by the end of the session, 9 p.m., you have to create this and start hard closing below it. Like, oh my God, you're in it. I just don't see any hourly hold levels that is targeting. So I'm not 100% confident. I see higher time frame stuff back here. Is there something lower time frame? So maybe like this as a ladder point, a ladder the move. You're not hard closing this 15 yet. Possibly you can say the hourly here could ladder it. So this indeed could be the hourly, as long as that's not a 4 hour. It's not an hour inside the 4 hour. So it's a deeper part of the higher range. So possibly if you go here and create an hourly, then that could give you the information you need. Or if you test this, although if you test this, you're breaking this ladder point. So I'm not really happy about that. So this looks like a good entry. And if you test this and hold it down and create the hourly, guess what you just did? You just laddered off the move. You confirmed that it's still moving down because you broke your ladder from here to here. You're continuing that. This ladder already broke this back here. So if this can hold, assume you're going below this. So maybe you go up, you attack that hourly, you create another 1 hour somewhere like what you're trying to do now, same kind of scenario. And you linger around here, create the hourly, and then all of a sudden you're, so it's like you have to think one step forward in the future. You have to think one step further, because everybody's always imagined. It's like when you first came into Cottonland and you're like, oh, maybe some of you are trading with indicators. I don't know, but maybe some of you are trading with indicators and you're like, oh, finally, we have a way to see events that happen before indicators. Well, now finally, we have a way to see events that happen before technical analysis, which is comparative analysis, which is now what butterfly effect gets into, right? Comparative analysis. So now we have a way to see even further into the future, buying the more extreme moments that make more sense. Imagine technical analysis is now like indicators, right? It's still one step behind because above technical analysis, you've got this type, you've got comparative analysis, which is this. So imagine comparative analysis being one step further. And then compared technical analysis, your traditional technical analysis that's, been in existence since the 1800s, these same things, think of them now as, your new indicators. I plan to make a video on this on YouTube, by the way. It's been planned for a while, just daily there. Yeah, it could be for sure. Let's see. Daily right here. Absolutely. The wick on the daily. It could be. You're exposing yourself to the whole entire range at that point with this one, WD. So like when you go and you test this, you're saying like the whole entire range is tested. So if you reject a rate off of this, then you're saying that daily is now tested here. It's tested here. It's tested here. Maybe it's not tested on the whole level that got created. So maybe it's not tested there, but any ladder points that can exist from here down are tested. So by testing this, you're saying that everything is tested in one sense. So it definitely could be, and this would confirm that 4 hour ladder, although I would like to maybe go after the hourly instead. And then, so now you open yourself up to, okay, what's been tested in here? And then you have to go through the whole queue. So yeah, it's definitely possible. We could mark it. I don't think it's not something I would take, but it's definitely possible. I would go greedier in the range. 150, which is at the blue one. That's just the 1 hour level that can ladder the move. Honestly, until tonight, I never separated CA and TA. Butterfly effect just seemed like a more advanced TA, but it makes a lot more sense how you can call it something completely different, because it does make the TA look like it's slow once it clicks. Yeah, actually true. Absolutely. I was doing Elliott wave and indicators before. Wish I found this first. It's really hard to ignore what you learned before, but getting there. Yeah, for sure. When you see the accuracy, it's just undeniable. You just simply, it just washes out of your mind. And it's okay that we take some time this morning to talk about this stuff, because really we're getting into trade management now and looking at things differently. And like all this stuff is exactly what we're supposed to be talking about. So don't worry about, we haven't gone through the videos yet. We still will today. Don't worry. We're not on any kind of time caps here. But like, these are really important conversations to have. The understanding that technical analysis is still slow in the markets. Well, that's kind of your secret sauce, right? Like people always say, like, how do you see these things? Comparative analysis. It's why I created it. Comparative analysis, because there's something that's even faster than TA. And that's the moments that are being created as they're being created. Because technical analysis means you're still trading moments from the past. You see, it's almost like a time clock. It's almost like we're speeding up computers as human beings. That's the way I like to look at it. It's almost as if indicators, they're so slow. So imagine this is like a super old computer and you upgrade your computer to go faster and get things done quicker and sooner and find faster things. You don't have to wait for dial-up internet anymore. And that's your technical analysis. And then you move into how do you speed up that? Because one day technical analysis slows down too, because it's just too old. It's like a first generation iPhone. Like, man, this thing, it just won't run anymore. Like I can't make any money on it. It won't run anymore. It's the same thing, right? Like, how do we get faster than technical analysis? And then in the future, how will we get faster than comparative analysis, right? But comparative analysis isn't even cracked yet. Like, it's what I do is comparative analysis, CA. So like comparative analysis is, you know, the umbrella going forward for the next, how many years? I don't know, 50, 100. But comparative analysis is the next breaking point, the new generation of trading, right? So that's like a really powerful thing to understand, is that even you could say, like, people are thinking, oh man, you should see Cotton. He's so much better than indicators. Dude, man, that's like my technical. What you think is faster than indicators is actually slow compared to comparative analysis. But people don't really get, I know, don't talk about that stuff too much, right? So people never make that connection, but that's what it is. Like comparative analysis is faster than technical analysis, right? It's just, you know, over time, I release those kinds of videos that talk about those things. And yeah, hopefully this helped people, because I think this is going to help people a lot with understanding trade management and the way we need to look at trades. Because I think a lot of the same stuff I'm seeing is people have reaction points, right? They have different kind of, here's a hold level, here's what I have to hold. It's very reactionary, right? It's very reactionary. And if somebody else is watching that and you're watching that, who's going to click the button first? Just the guy with more kahunas. But then that person also exposes himself to not being in position. So that's not really a smart play, is it? Like, oh, I got bigger balls, I clicked the button first. Well, that's not really thinking with our minds, is it? Isn't there a smarter way we can do things than just being egotistical, right? So then there's that side of it too, right? Guess it's much harder to market yourself as comparative analysis when you invented it. Yeah, exactly. It's not exactly, yeah. What the hell? Didn't quite understand what you're exposing yourself to the entire range by only prevailing the Wick, because the Wick is testing a lot of stuff. Like if you test the Wick, a test of a level, this means it's also testing the daily. So you don't separate these, JP, by, oh, we tested the greediest part of it and we tested this part of it. You can, but once you've tested this, you've tested both. The level is tested. It's a level, it's tested. You can move down and say, oh, but we didn't test the 4 hour within it. Well, we actually did right here, but maybe it's testing the hourly. Okay, so you create reverse points. What about the backside 4 hour? What about the front side 4 hour? So you're in essence, what you're doing, you know, by like testing. Oh, damn. Was I in the wrong spot of the move? I was in the wrong park. What is, oh, on the weekly, I clicked the wrong button. I'm like, what happened to my brain all of a sudden? So like here, you mark this right here. If you were to go to the 4 and say 4 hour has been tested here, right? Mark this as a 4. You go in here, find the 1 hour. You mark this guy here as the 1 hour. Delete some of this out. Well, we need this one. Let's not delete that one. You go back to your daily time frame. You may test well beyond this greediest point here, all the way down to the hourly. You may test the 4 hour. You may test this level. But once you've tested the daily, you've tested the entire range. So where is it going on its first push? Because that first push will create its ladder point, because there's different scenarios that happen. You go here, well, that creates your ladder point because it held this daily level. It would be very tough now to come up here, test the daily level a second time and move down. You'd likely just be laddering off of this. So this is telling you something very different, right? Typically what you see is like, you see these kinds of things like this. It goes after like the greediest part of the move. It goes down, creates this as the next ladder point because it's the greediest part of the move, or this, one of the two. But you see, once you've tested this, you've tested all of it. Once you've tested this, you've tested the entire range, because this is representing the range that goes like that, right? That range inside of there. Once you've even tested the Wick, you've tested the range. So where you test in the range defines your ladder points and what could happen going forward. But again, it makes total sense because it's like, okay, well, if you test this, it can give you the ladder point, and then that ladder point could act as a reverse level in the future, which would just be this daily got wicked through, it hit this, it's the perfect ladder point from there to there, it creates interior trends, or from here to here, or however the tests end up working out, right? So then it all just kind of makes sense in the end when you test one level and why it tests a level once, and you know how the range works. Counterintuitive because we're creating accumulation candles showing we're moving up, but when we think what can be created, it actually serves as a hold if we can get under it. It is a bit counterintuitive. It's a bit tough to wrap your minds around, but once you do it, it just makes, imagine buying a hold level before it's created, right? Imagine buying, you know, a dump before it happens. Why do we need to create the hold level before we buy it? We use other micro time frame things to justify larger moves, ladder points. We use all these other things to justify that.
Trigger points are something that
there we go.
is very helpful when we're talking about exits, when we're talking about managing trades. It is a little bit of procedural analysis mixed with technical analysis. So it's a bit of a hybrid unit, right? You have procedural analysis, which is typically the way in which we trade, which triggers are actually exactly that. It's the way in which we manage a trade. So it is part procedural, but it is mixed with technical. So it's technical derivative and procedurally executed. So it's kind of an interesting blend between the two worlds. It's part of a hybrid model where you get into even more advanced knowledge, not only using the way in which we appropriate our trades, but combining that with the actual technicals that tell us, okay, our technicals can appropriate exits or entries, things like that. So it's kind of the step above procedural and technical analysis. Because it's a hybrid model, it really becomes the kind of almost ultimate form of trading, just because it's mixing the most advanced theories, right? So Pickle's dad was in a short here. So we are going to talk a bit about that and how we would manage that short to understand trigger points here. So I'm not going to look too far in the past. Like if I did, what I would find is I would find a trend that comes from, say, I believe it was here to here, and eventually it gets to this point on the larger time frame. I believe it's something like this on the bigger time frame. So, you know, we're not going to, yep, I know it's this point right here. And it's somewhere on this one right here on the smaller time frame, just as a local trend. So we're not going to, you know, go and reinvent the wheel here. We all know how to do that. Rather, we're just going to kind of take this a step forward here. So you'd have your trend like this, which is great. And then you'd have an even more local one, which would be this candle here to this hourly candle right here. I believe this would be an hourly. That's
trigger points was one of your favorite parts. Yep, we're just going to give a quick statement to trigger points here. It's just like I said in the video, this is all about trade management. And at this point in the course in the series, we shift into understanding trade management. So yeah, trigger points is a great lesson, and it's really going to help us develop what we call shields in the trade, which we're going to continue talking about after the lesson.
Sure, what it looks like to me. Yeah, so it is actually. It's the
keep in mind we use trigger points as trade management to manage our positions.
I'm just doing a little bit of trend shortcutting there. Just experience shows me where I can put these things and what time frames I can expect them on. So just a little bit of shortcutting to see where this these trends are. So last time we talked about trends and did an overview on trends and kind of how we use them interior and exterior wise. So this would be considered interior trends, right? These you're going to get out to this weekly here, and this is a bit of an exterior trend, but really this would be the local exterior trend. I'm sure there's trend here to here and yada 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 and to this point here and some different things, and this would be a local trend. Just to clarify that, this is a local trend affecting this part of the move. So what we're expecting from this trend before we move on is simply just this, something like this piece of the trend, right? Here's the hold level, and that's exactly what's been being held over time. And then I'm sure there's even something a little higher here. So you'd have this hold level gets hit in there, and then this one right here, and so forth and so forth down. Actually, you know, this was the untested level, and that's fine. Is now moved to this range here, and then so forth to here and here. So
when we're looking at this on the screen here, walking through these levels, we have to use levels and trends all together. So whenever creating trigger points is where we would get out of the trade. And it really opens the understanding to that trends shouldn't be traded in terms of opening up a contract on a trend break. So if we were to trend break up, it really shouldn't be something where you open a trade, because the risk you introduce yourself to is high. It's extremely high. Rather, you should be buying the hold levels below that can attack those trends, because the reality is if the hold level holds, creates the ladder point, that will eventually attack and break the trend. So why take the risk of playing the trend when you can play the hold level that would be holding the move to attack the trend from below? So we always create these shields in trades. And if you were in a short, you could use this trend to exit the trade, right? Like trend breaks, you're in a short from back here, you can use that to exit the trade. Or if your target gets hit on the bottom, you say, hey, this hold level is going to hold the move. If it continues to hold the move and we continue to develop a ladder, that can also be like a reverse shield, something that would allow you to exit the trade even before you release yourself, exit in profits, or like we showed as a hold level being a target, that could also be like a release point or a trigger point for getting out of a trade. So I refer to trigger points as trends because it's a very easy sediment to make people understand that trends act as trigger points, and they're a moment that releases us from our trade, just like levels and just like hold levels that aren't created in the future. There's many forms of trigger points, but I relate them to trends. So I have a different definition. I use the term shields. What can shield your trade in the moment? But really, a trigger point is another shield. So just to keep that aware, that there should be not a big distinction between a trigger point and a shield, as they're both moments that if they occur and if they're in succession, then what happens is you're going to have the breaking of a move, right? So it's good to know that like we're doing work with hold levels and trends here. But also on the other side of the chart, what could break those hold levels and trends? Well, the hold levels can and the ladder point. So that's important to realize too. There has to be a point where you're in a trade, like say for example, this trade, you're in a short from right here. Sure you guys can see that, my mouse cursor on the screen. Yeah, you're in a trade from here, right? You start moving down, you hit this ladder point, you move up to your trend, you hit this next ladder point, you're still laddering up the move. You have a wick that breaks over top of these ladder points and then goes down and holds a move again. Well, that could be a trigger, right? Because you've kind of invalidated one set of criteria on this side of the chart. You've wicked over the ladder point, and so that would be like, okay, we're breaking the move up top. And then we hold the hold level down here that gets created. We hold this hold level down here that gets created, and we're laddering up while also breaking this side. Like that could act as a trigger to get out of the trade. That could be like a preliminary trigger where you all of a sudden created an hourly hold off of this right here. Maybe this one, as you zoom out in time frames, oh, we're on a 12-hour. Okay, so let's pretend this was just like a 5-minute candle, and you created an hourly right here. You're about to hard close over that hourly. You've already broken this. You've laddered this side. Like it's just the writing's on the wall. So we have to look at trade management as what keeps us in the trade and what breaks us out of the trade.
You know, we can just kind of establish our very first. This would kind of be the legacy.
Many factors, not just trends.
Information here, right? Like you have, this is very local. What we're looking at in terms of May 7th to May 23rd. Very current, of course, and somewhat localized, and even this isn't too local. More local is going to be in these first few candles here. But anyways, it gives us a good balancing point to establish some of what we're going to talk about today. So we're going to work through time frames here and see that we do have, it's the hourly we found this on, right? We do have some information already that we can use with these few trends that we've drawn. So we simply know that Bitcoin has been moving down, and we are looking at this trend to continue its movement down, and this trend out here, and eventually this trend out here, if we get to that point, which I'm not so certain we will. So let's start by developing our other side. So we simply have this, which was a test of this guy right here. Funny enough, this range had been tested. I believe there's something else in here that was tested. We're not gonna dive too much into that because I believe we did that in a previous session. So next we'd be down in this region somewhere. So this sort of tested right there, which gives us our hold levels in here, which broke down into this range here. So we can kind of define this range as well, and we're going to spend a little bit of time doing that because we do need to know what we're dealing with for trigger points. So very, very first call, we know range is here to something like this. And this one is kind of already tested, which means we're here, but more likely this candle, and so forth and so forth. And which was tested, this here, which is tested. And, we've tested this one, I suppose, next, where it stopped, and you figure it's tested, and maybe that's fine. I can test a second time. I'm not too concerned about that. So really what I want to do is look at the bottom of this range to develop what exactly we can expect from this move. And this is kind of like almost like a legacy expectation here of what we would expect. You have this right here is a pretty untested region, and even going back and seeing this a little further, and if there's anything there, sure would like to see it. Yeah, and there is. You've got this right here.
Well, this is cool because you know what? When you have and you're developing this architecture, you can often see where your ladder points are developed. And so if a 15-minute level gets hit for a second time and holds it, you can often see that as a ladder point on a bigger time frame. So for example, if you were to backtest this level a second time, or whichever level we backtested, you can move up in time frames to see where the trend and the ladder points exist, which starts to give you definition. Like creating definition in charts is important. It's like, imagine a move just happens, there's not enough definition yet, and as time goes on, more definition gets rendered in by just simply having more information and data available on the screen, right? So another really cool point and kind of this black and white moment in charting is saying, okay, you have technical analysis, right? You have trade management, comparative analysis, but with technical analysis, you're just marking moments that had already been hit, right? So now split your definitions between, or split your theories into, has enough definition been created yet, yes or no? So now you're asking a different question again. Now you're back to that same thing. Like, what are we looking at? Technical analysis here. Has enough definition been created yet? Well, definition is a part of trade management, right? You create definition in the moment and you use that definition and create more in the future. So now you're into that scape or that scale of trade management, where it's, comparative analysis is one thing, trade definition is another layer inside of comparative analysis, or beside it or inside it, whatever. But it's like, have you created enough definition yet, right? It's a really clean way to think about it.
That's great.
If that makes sense. I'm not sure if that makes sense to people, but hopefully it does.
So you're starting to define your range, right? Like, this is tested. This one is not. This one is not. Let's go to the 1 minute, see if there's anything even more defining. This is getting to be kind of the final spot where this move would hold, if it holds. And if it can't hold, then, this is kind of where it breaks. So let's definitely spend a few minutes finding that. Okay, now we're getting to the good parts here. Great. So very clear on the chart right here. This is a very, very clear spot where it is. So 82.73 is a very, very clear legacy target. It's going to be our final moment in this trade if we're going to hold up this range of the move. So we can kind of go back to the hourly here. Great level. I love that level. So immediately we can say, okay, from this point here to here, what is our, let's talk about profit cap, right? Like, this is our profit cap. So this is kind of our max expectancy, just like we did a profit cap up in this range down to here. Our profit cap was 10% last time, because I believe it was 97.20 or something like that. I'm just going to use 97.20. I believe that's what we had. And it was all the way down to here. It was roughly 10% where our profit cap was. So I believe it was this part of the range right here. So we were talking about a 10% profit cap, which it's perfect. It hit. And now we're recreating that same scenario, right? So we're in this kind of profit cap scenario where this is going to be the max of the move. If this level breaks, you're very much going to be down in this range here. So we've defined the ranges that can be a possibility here. We've defined our profit cap, and now we can work inwards from that, right? We've created these exterior moments, just like levels and trends. We've created these exterior moments. Even a profit cap here is kind of an exterior moment. It's going to have interior moments too, right? Like an interior profit cap would be something like this, like, oh, we could go here. Okay, well, when we lose this level, then we're going to go to this level, right? Or something in this range. So this is like range 1 right here, range 2 right here, range 3 down here. So then you kind of have your 3 profit caps. So if you're in this trade right now, say you short right now and your profit cap is here, yeah, you've got a pretty cool and easy 2%, great. And then maybe into this you've got a 4%, and then maybe into this you've got like a full 10%. So that's kind of immediate expectation. Almost think of it like scalp expectation, swing expectation, position expectation. Not saying that the longer you're in this move, the more you're going to make. What I'm saying is that you have 3 different kind of time frames that it's going to take to get there. Obviously, one level is going to be hit. It's going to have to collapse. It's going to go into the next range. It's going to have to collapse into its final range, which is going to cause a reaction up, right? Good. We've established some profit caps on this. The levels that we want to look at. And maybe we need to go and relook at this top side here. Now that I'm looking at this on a smaller time frame, we had this, I believe, on the 4 hour, which really does look like this on the 1 hour. So working down in time frame. So this was the 4 hour, completely unencumbered, which is nice. But then really we want to have it more specified to the exact moment. So we have something like this right here. we go back to the 4 hour, it's relatively the same level. Like you're relatively the same level there. This right here, which could be target 1, this right here, which could be target short 2, and then possibly you have something even deeper. So something like this looks pretty decent right here. This also looks decent too. This is the backside. So then the choice becomes between backside, frontside combination levels here on the top. So then you have, you know, your range up top. So you have your range.
So backside, frontside there, just simply you can test one of these two, right? It's a range test.
Up top, you have your range below. And then you're going to have
creates
more
the ladder point
too, right? Like you're going to have this guy right here.
Reverse the backside, reverse the front side. Either way, you test the range.
Pretty decent level. It's
what creates the ladder point,
untested.
Right? So if you're going to create definition in a trade, you see which level you attack, and then, like if you were to test the back side, it'd be pretty tough to ladder the front side unless you were very close in time frames. So an example of that would be like this: you move straight up. You move straight up through the trade, you hit the backside, you have a small pullback, right? You're still within maybe 4 hour candles or 1 or 2 of them. You go right to the higher part of the trade, you pull back, it goes like this. You go up even higher, it pulls back. That could happen all in one small section of 15-minute candles over and over and over, or 5-minute candles over and over and over. And then if you were to zoom out on time frames, you could simply see, hey, there's a 4 hour ladder here to there, which gives me the reverse level of the highest time frame. So that would be one way to create definition if you did that. Another way to create definition is if you went straight for the front side, moved down, you could ladder the back side, which presumably here would be the 4 hour body, it looks like. So this would presumably be the 4 hour body as a reverse level. That would give you a different type of definition. If you went straight up after that second level, moved down, then you'd have like a 4 hour reverse candidate. Or alternatively, you could go straight up, go here, come down here, and be holding something back here. That would give you a different definition, right? So creating that definition in the moment. Another scenario is we're moving up, we go up here, we fall short of the level, we move down, and then we create a ladder point that never attacked these, but attack something in the larger time frame back here, maybe an origin level, which wouldn't make these a candidate for reverse levels now. It would be completely different, right? So there's different ways in which you can create definition, and usually the distinction becomes in how much time has passed, right? And like if you're sitting up here and you're attacking levels in such a small time frame, like over and over and over, right? You attack this level over and over and over in such a small time frame, that could be a larger ladder point developing, right? Or if you hit one ladder up, that doesn't mean you're breaking the move. Again, this could be a completely different definition. So when these things happen, definition occurs across time.
Range is this one here, tested right to the right, and that's tested there. This range is tested once, so you could say that once this breaks right here, whatever this range is, so that's what's right now. So this range here on the higher time frame could go after this right here. See, then you have a few different targets above too. So, okay, that's fine. We just want to develop a few different targets on both sides to talk about trigger points. Really, the discussion about trigger points is the piece of work that we do after we've kind of entered this trade. So we're going to enter this trade with trigger points in mind, and we are going to say, okay, we've got our targets. What do we do with our trade? Like this is a technical analysis part of this, right? Like this is the TA part of this. I'm not sure why I had that level mark there. I'm going to leave it there. I don't want to get too much into level finding, and it's a common practice that I do where I mark my hold levels. I'll go back into my charts, remark them, see which one makes the most sense. That's common practice, right? Like even here, I'm looking at this and I would say, oh, like actually this looks really good right here. This backside is tested. I think this front side is pretty good right here. So I'll commonly go back into my charts just as a heads up. I'll go back into my charts to see what level makes sense and continue to go on. Okay. We're going to rewind this a bit and treat this as if it was a trade that we are in. Okay. So trigger points become the moment where we exit trades. A trigger point is something where we are in a trade. Okay. So we've executed a technical analysis portion, right? We've executed a technical analysis piece and we are saying, okay, procedurally, where does it make sense to either get out of this trade or take profits in this trade, right? So this is the part of procedural analysis where it's kind of execution, right? It's less technical based and more decision making, right? So except in trigger points, it's hybrid, right? It's kind of like the ultimate form where you're combining procedural and technical. You're using what are called trigger points. So let's just use an entry point. So we're going to just say, okay, we entered here on this hold level, and that's fine. You've got a backside hold level here. So we'll take it back to that moment in time. You've got a backside hold level here. You're saying, okay, I want to enter here as a long. Great. The hold level held. You're going to make your uptrend, right? You've got an uptrend. Your hold level is held. This is no longer part of the move. Instead, you have whatever's developing in this move now, right? Like your hold level on this side. So you've got a hold level on this side that you don't want to break below, and you've got a trade that you've entered based on this hold back here. So now you've created a trend. So a trigger point is something where we run through our charts and say, where do we take exits? Okay, so you're going to have different exits, right? You're going to have your holds up top, right? So you're going to be either here or here, depending on how much profits you're in, right? So the first thing you're going to do is you're going to say, okay, what's my profit cap on this trade? Well, okay, let's see. This hold level here, this was hit, so that this is not going to be respected. Okay, so the range is back here all broken. This has been hit. This has been hit here. This has been not touched. So you have this level going to be polarized gapping to this level. And then even I'm going to go to an hourly chart here and say, oh, okay, we're more likely in this piece of the range here, right? So below this and above our previous price. So that's kind of like right here, right? So this looks like a good spot. And if you want to take profits backside, you would measure that, right? You would say, okay, I've entered here on this hold level. And what are my profits to this level? It is 3.8. To this level, it's 4.17. Yeah, I think 3.88 is good. I like 3.8 here. I don't really feel like I need to push the marquee on this one. Most likely it's going to go up a little higher. If I had to pick a level, I'd pick this one personally because I'm a little greedy, but for purposes of profits, which would end up being moved to this level. For purpose of profits, I think it's okay to just take 3.8 here. So I would take 3.75 and set up my short for the next trade. But if you wanted to get really greedy, I think for the purpose of profits, it makes sense to just take the easier exit, especially when you're talking about 3% or something like that, right? So you're in this trade, you've entered right here, you've drawn your trend. This is what's going to hold the move, and this is where it's going to go. So we can delete this one. So what do your trigger points become? Your trigger points become either targets or areas where you exit a trade. So you would say, what's your trigger on this trade? The hold or the trend, right? Like that's the way I would verbally communicate it. So if you guys knew trigger points, I would say, okay, what's your trigger on this trade? Where's your trigger? And you'd say, okay, trend and target. Those are my triggers. Okay, so those are both trigger points. So you would say, okay, I've got two trigger targets and trend, right? What's your triggers? Two holds and trend. Oh, okay, two holds. So then I would instantly know, okay, you've profit capped this move. You've profit capped it to here and to here. So you've got two trigger points on top, two holds, and your trend. So what that means is you're either going to exit here and look for the re-entry without breaking this, right? Now, this is a little bit of technical analysis. This isn't the definition of trigger points. The definition of trigger points is where we exit trades. What triggers an exit, right? So what could trigger an exit? I guess we're stepping a little too far ahead. What could trigger an exit is you go and you break this trend. So you close this trend, you get out of the trade in profits, because as time goes on, this trend is only going to go up, right? So as long as you're holding this trend, you can just simply stay in this trade. And one of your trigger points, you can just say, okay, you know what? I've entered here. There's no money lost if we break trend, because I simply get out for a neutral sum trade. There's no profits, no losses. Yeah, maybe I missed the trigger up top. Maybe it went here, but I was like, okay, I want to exit on trend break, and it came straight down and you exited here. Fine, you can do that on trades. It just becomes more of a position trade, right? Or not a scalp. Scalps are more enter a hold level, take an exit, re-enter another hold level, take an exit, right? But those doesn't mean they're not trigger points. Trigger points are simply where we exit trades. So like a really, really smart one is trend, because this trend, until this move is just going to keep moving up until this trend breaks. So hopefully I'm right about that, and presumably I should be. But this will, at a minimum, even if I'm wrong, even if it breaks right here before hitting this target, even if it breaks, you're still in profits. It's just not as much as you could make. But that's the whole point about triggers, is that hitting a target is always going to be maximum profits. So hitting a hold level target will be maximum profits. Breaking a trend, again, is more treating this thing like a position trade, or treating this thing like a swing trade, okay? Because you could theoretically hit this hold level right here, right? Which is exactly what you did here. And then go straight up before, slowly coming down to this. And then you exited here because you broke this before moving down, right? So you could, again, you can treat this trade in two different manners, like where your triggers. Well, your hold is a trigger, that's where you exit, and your trend is a trigger. So when we look at this, we have to start combining what a profit cap looks like, where the maximum possibility this trade could go. Not only the kind of maximum possibility where this trade could go, but how we want to manage the trade. So we're going to go forward a few candles here. We've entered our trade. Great. Target one is hit. How much did we make? Oh, we made 1.2% relatively quickly. And then we, this is one trigger point because it is an exit, like it's triggering us to exit the trade, right? So it's a trigger point to get back in the trade down on the hold level, right? But we have the safeguard of this trend, right? So we're going to go forward a bit. Got re-entry on. I'm assuming that maybe this was a backside on a different time frame. It's fine. We're not gonna go and get too crazy with this, right? Okay, you break over this. This is obviously polarized. This is exactly what we talked about. Once this level gets hit, this is polarized to this point, which is just going to go into a higher range. So let's say we didn't take this exit right here. Let's say we didn't take this exit. Okay, we're going to work with two scenarios. Scenario one, we did take the exit. Scenario two, we didn't. So scenario one, we already made 1% and we got back in the trade. So now we're looking at another 3.6. We made 1.2, we're looking at another 3.6, okay? For this example, I'm going to say 3.28. Again, I would take this level, but I would be using also other trigger points, more interior pieces of this move, such as an even more aggressive trend like this to see, okay, I'm in this trade, what, the balance between taking 3.2, 3.6, or breaking this trend. So there's also a, an interior balance there. But we're going to work with two assumptions here. Assumption one is that we've done two trades. Assumption one is that we're still in the original trade back from here. So in scenario one, we are still in this original trade back from here. You can start making more trigger points to say, okay, I want to be in this trade from here to here. So once this trend breaks, and we're just going to make sure there's nothing a little higher on the hourly. There's not. It would really be this point here to here. There's another trigger point, right? We're in this trade and we're even higher.
So this would be where you define more of an interior trigger point because you want to lock up profits and you're not entirely sure what the trade is doing. So I think if you're using this interior of a move, you're just trying to lock up profits because you would say that the other spot would be, got a hold level right here. As long as you don't hard close under that, you're fine. And as time goes on, the further you get away from this trend, the more likely it is to move down, right? Because you're going to be saying, okay, well, there's two sides to this. One, you're hard closing under this trend. So the further you get, you cannot use this trend as a trigger. Like if you're coming all the way out here, you can use it as a trigger, but realize it's not going to break below this stuff down here because what it's going to do is now it's in a higher time frame spectrum. So the further you come out on this trigger point, on this larger trigger point, the more you have to look at your larger information, your bigger time frames, because by breaking that trigger point, all you're going to be doing is hitting a different hold level. So you would almost want to use a higher time frame hold level as a shield on the trade to say, if I wanted to stay, now you're getting into a difference of scalping and swing trading to say, okay, I want to stay in this trade because I think ultimately it's going up long term. So I do want to be in a swing or a position trade. And the further you get away from this trend, that gives you a very clear decision of this is like just take profits and re-enter that level versus rebuying that bigger hold level. Like you can't use this larger trend out here ultimately to say, hey, this whole move is breaking down once we lose this trend, because at that point you've already made your larger information. If you were to come straight down and break this trend though, however, that would be a great trigger out spot without any kind of reserves to say, well, there could be another spot below or I can re-enter the trade. At that point, this trigger would be like, okay, you've lost the entire move and you're breaking down past this range. The interior trend would be very much the same thing. So you just have an interior trend that would reflect this range right here where it's created. So your interior trend will reflect this range trigger point. So the trigger point will reflect this range. This trigger point will affect this lower range. So again, if you're triggering out here, you're triggering out with the intent to get back into your trade on the larger time frame information that was created, because now that's just going to create like the larger time frame trend, the more relevant trend in the moment instead of such an interior piece given time. You have to think of trends and how they trigger out as trends over time become stronger because they create bigger points in the chart. 4-hour hold level gets developed or whatever. So the realization of trigger points here is that if you are triggering out of this trade, the re-entry spot, because that's how you have to start thinking about trade management too, right? Like if you're triggering out of this trade, the re-entry spot becomes what this range is showing you. As to where if you trigger out of this trend out here, the re-entry is what this is showing you, right?
In profits, we're in this trade and we're even higher in profits. 1 second here. Just going to close out my Discord for a few moments. People are starting to bother me.
You can now, we'll wait till this is done and I'll talk about it.
We are in this trade here, right, from this point, and we can exit this trade. We're still in profits in scenario 1 right here. We're still in profits from this trade here until we break this trend. And if we wanted to stay in this trend trade even longer, we could simply just stay in it. Breaks here, we can trigger out right there, or we could stay in the longer trade here and do a trigger exit there. Again, this is going to be a dictation between what are you trying to do with the trade? Are you trying to go for a longer trade with larger profits? So I want you guys to think back to this trade back here where we said, okay, we've got 2%, 4%, 10%, right? This is the same thing. It's like, okay, the longer this trade is going on, the more you're going to make, which means you have to use less localized trigger points. So a localized trigger point would be something like this extreme one right here, where you're saying, I want to reach this target, but I will exit if I break this. Because again, it's your trigger point. Because once you start to lose that move, once you start to lose whatever trends are starting to bring you there, you're going to go back and test lower parts of the range. Like that's the whole point of trigger points and trends, is that once you lose a trend, you start attacking the next range down, right? So you have a trend is created. If trend is respected, you're moving the same direction, right? Kind of like common sense. That trend is broken. This trend is broken. It's going to attack a lower range just by default. It's going to sink back to a hold level on a higher time frame, or it's going to just go after the next range if it's polarized.
Yep, exactly.
And that trend is the last thing holding it up.
Higher time frame. So, like, I just want to rewind this here for a second and talk about something. You have a trigger point in a trade, and a trigger is a trend. This is different than a shield. While I said earlier they were both kind of the same thing, they are, but just realize they're points where you need to be exiting trade. So they are in that respect. Like a trigger point here, realize you have two choices, trigger points and shields, or hold levels and trends, right? A trigger point can give you your profit where you want to re-enter the trade. So a trigger point is often, I think people look at trigger points in one way. They enter a trade, right? They've entered a trade, whatever, on this 15-minute backside hold. They hold this trade until it breaks that 15-minute, just with the no further consideration to the trade, just with the understanding that, hey, I locked up profits. But then when the trigger breaks, realize it's likely going to go after the shield of the move. So you have a choice here to trigger out on the trigger point, which is your trend, and that locks up higher profits. Now, depending on which trend you're breaking out of here, you might be, say this blue line here on the screen is your 4-hour hold level. I'm not sure what this was. I think it was just an inverse hold level, but maybe it creates a 4-hour hold level. If you break this right here, you wouldn't want to be exiting right here to go after your neck. Like you wouldn't want to be triggering out of this trade to hit your shield to move up. So, and that's important to realize where the shield of the trade is, because alternatively, if you were moving up fast like this and you triggered out up here, you would re-enter on the shield of the trade. So sometimes you'll use your trigger point as the deciding factor to get out of a trade when the gap is too big to the actual shield, like the 4-hour hold level or whatever it needs to create, or whatever the target is. It could be the 4-hour hold level on the inverse side. That could be your shield to the trade, which acts as an entry point. Now, if your trigger point is close to that, realize that if you're triggering out just to re-enter there, that kind of increases risk as opposed to waiting to see if that hold level just gets blown through or not. So in one scenario, you increase risk by increasing the amount of positions you take. In the other scenario, you're holding past the point. So a trigger point doesn't always, like every single trade you take, it's a choice. You shouldn't always just say, oh, trigger out of the trade. Like, yes, that's fine. Trigger out if you want to lock up profits, but there's also shields in the trade too. And it's a stylistic choice between how far. Like if you are all the way up here and you're not quite hitting this level, but you're up here and you're about to lose trend, like, yes, trigger out and re-enter down here. If your 4-hour hold level's right here and you go straight down and there's like, well, trigger out here to enter here, you might actually be losing money on fees, and you might want to use the shield as your trigger point. And if that shield is your trigger point, you've got the larger component out here, which has a hold level below it. So just stylistically, you always have to be aware of triggers and shields. Like, what are the hold levels? What are your shields in the trade? The hold levels of targets, the things that can be attack and failed. Typically, I don't think you want to use the creation of a hold level. Like what we were doing earlier today, you wouldn't want to use that as a trigger because it's very deep and you're leaving a lot of profits on the table, but you've got that stylistic choice. Okay, let's move on.
Okay, we've got our trend there, right? It's holding us up. Perfect. So this is a point where we would say, okay, we're actually making more and more and more profits as time goes on with this trend. Okay. Here, we could exit the trade here. So that would be trigger point number one, if you wanted to just take guaranteed profits. So that would be kind of saying, we were in the trade here. We exited the trade 2.26%. You could also adjust this out to a more local piece and give yourself a little bit more breathing room on this trade. That's perfectly acceptable too, right? Unfortunately, as you see, our first trend was bang on, and we actually took the perfect trade there. You can give yourself a little bit more breathing room, right? Would have made, I believe it was this candle here. Hard closes a trend. And I'm sure there's, if you did move this more exterior wise, like what I did, or sorry, the local trend, giving it a little bit more breathing room, you can still see that moment in the local time frame. So you can still see that moment where, hey, I'm losing trend. You should probably look for an exit before the larger dump, right? Like that's just, we're on 15-minute time frames. Don't be surprised when you see a huge candle, kind of sink down like that. Where did we find this original trend? I believe it was about a 5-minute chart. I'm not sure where we found this original trend, but okay, nevertheless, that's fine. It was kind of like this region, right? Oh, that's why. It was this right here. So that's fine. That's a clear trigger point, right? Distribution candle to distribution candle gives you your trigger point exit, right? So if you were in this trade here, you would have said, okay, I either hit my target, I take my trade there, right? You make your 1.2, you re-enter here, right? So you made 1.2. Measurement tool. Oh, it's still on. You made your 1.2. You went from this candle hold to this trigger point here. You made another 1.59 or one. Well, we'll just call it 1.6. That's fine. Easy math. So you're up 2.8%. Alternatively, in the other scenario, you were from here to here, 2.2%. So you've increased the amount that you can make based on having trigger points. So you had a trigger exit, you had a trigger entry.
I think this is kind of exactly what we're talking about, where if you're triggering out of the trade, you can realize, before I move on the video, I don't remember what happens here, but this is that moment where you can say, okay, how much is this gap to here? Are we going to hold this level? And maybe we should adjust our trigger.
And then you're simply just using hold levels and trends to dictate where you're exiting trade, instead of always looking at targets above, right? Now, it doesn't mean this is from here to here isn't a valid trade. It doesn't mean that from this to this isn't a valid trade. It's not always going to get executed, but it doesn't mean it's not a valid trade. But then if you're going to go after that bigger target up here, you also have to use your bigger trigger point. So once this breaks down, you're just forfeiting the profits of whatever you make. So we're just going to play this through a little bit here, just till we get to this other trend. We're on that trend now, and no, we're not hard closing yet. That's fine. And we intersect with our larger trend. So over time, instead of actually just hitting this as a target, we simply hit our trend, which is going to not allow us to go after this. Now, sometimes you are going to go to the hold level, fake trend break, go down, but that's not always the case. But that happens often, like when a trend is going to break. So for example, if this trend was going to break, I would expect this to come attack this hold level before rocketing up. Like I would say, oh, we're going down to this hold level right here, like that, and
create the larger
rocket
time frame
up
information
over to break this kind of the extreme hold level that's going to break the trend, right? The injection point before a massive trend break. That's how I would expect trend to be broken there. I would also delete those. I would also expect this trend to hold off of this hold level. So you fake break and then you fail down in a big way, right? This just kind of respecting trend just tells me that it's more of an elongated move that's going to Pandora's box between some kind of levels in here. Nevertheless, it becomes a target and a trigger point. Like if you were in, you have to think of this. If you were in a short from up here, right? If you were in a short from up here, you entered off of whatever hold level here, and you said, oh, here's my trigger point. Once this breaks, you'd also relatively exit. So you have the same trigger point on the other side, exiting the trade here. So it's you're going to have the same trigger point from here, a short from here that's saying, oh, I'm going to exit once this hard closes, is the same thing we are doing right now on the opposite side. So you just keep that in mind. So you're in this trade here. You've profit capped yourself from here to here. Remember, this is the profit cap of the move. This is where it's going to go before it tests and pulls back. This is the maximum that can be made. 4 points. We're going to call it 4.2. We're just going to round up 4.2. Okay, 4.2% maximum it can make. Alternatively, it hit 3.79. Fine, we're still in this trade until I love.
And I think that's where you have to refine your trend to make sure you're on the right time frames, because enough time has passed. Like, this is where I would have possibly refined my trend working down. I don't know if the 4 hour would be enough here, but it looks like it might be. It looks like it may break and go after a range trend.
Lovely trend breaks down, right? So then you're right here.
But I think when you're using trigger points like this, I think you need to take that. Like, if you haven't hit your profit target, if you want to stay in the trade or turn it into something different, I think you need to go at this point in the trade and always work high time frame down and see what's available.
At this point, you are saying I'm sure you had some kind of sign in here on a lower time frame, or even if you got out right now, that's fine. We're just going to take this as an exit. 3.04 instead of 3.79. So we've developed a few different scenarios here now. So let's talk about all the scenarios. Scenario one, we took this to this, and then also this to this, giving us 2.8%. That was one way we executed triggers on this trade. Taking this to this is 3%, right? Trigger points, as you can see, give you more profits and eliminate the need to hold things, because you made 2.8 here, and you made, I think it was 3.04 here, 3.04 here. The difference is very small. If the difference is saying, oh, do I want to take this hold level as an exit or this hold level? It's the same splitting of profits, the same splitting of hairs, right? Your profits aren't that much. Now we're going to say, okay, fine, great. So in one case, we started scalping, and we kind of stopped the scalping right here. We said, oh, we're going to stop the scalping right here and no longer be in any of this, right? So we're going to stop the scalping there. Let's delete. No, we're going to keep this one. If we had never entered a trade, we made almost relatively the same money. Now we're going to use the next hold level here, enter this trade. Same thing. We enter this trade here. We take our trigger point and we put it right here. We either, so this trade was executed. So we're going back to scenario 2 now, I believe it was. Well, it was scenario 1 or 2. I'm not sure which one I named it, but anyways, the scenario where we're scalping and we're already in 2.8% profits. You're in the same scenario. All you've done is fray out your trigger point, right? Take your hold level, fray out your trigger point to here, and we're going to use this candle here. A hard close this candle on a smaller time frame here. So you've got another 1%. You could have possibly made a full 2% on this. That's a heck of a trade. You could have even used, this one to this to give you your next trigger point, right? So you could have even continued to go more interior with these trigger points, and you see one trigger point breaks down to fray out this to the next trigger point, that breaks down to go to the next trigger point, just as trends are supposed to act. But when we get to be better traders, we call them trigger points because we understand their value is that once this trend here breaks, it's going to go after the larger trend from here to here. So once this breaks, you can expect a price gap between there to that one at a minimum. So there's almost a losing of profits there, right? So let's measure the losing of profits. When you break this one, if you're going down to the next one, come on. If you're going down to the next one, you're going to lose. We're just going to call it 0.7. I believe it's about 0.7 there. It's 0.65. Okay, so we'll say 0.6. You're going to lose 60% in this trade if you're 100x leveraged, right? So it's almost a polarity gap from trend to trend to trend, right? So by hard closing this trend, you are going to lose that. And it is why they become so valuable trigger points, because you're just simply forfeiting profits, right? If this, go back to right here, right? If this trend is going to continue holding, it's simply going to break down to either its next hold level, right? Or its next trigger point, which you can see right there. Probably breaks down to its next hold level somewhere. Yeah, right there. And it actually loses the next trend and breaks down to its final trigger point. But that is a separate trade completely. That trade, like if we were to delete all of these trigger points, you're still in the confines of the larger trigger point, right? You're still in the confines of the larger trend getting you to your target. So you're still in that same confine of that trend. So really, all you've done is put yourself back into a scenario where you're saying, okay, position trade, swing trade, scalp trade, right? Like it's the same thing, that you're just bringing yourself back into that local, global, legacy part of the move, interior versus exterior, right? It's that same splitting of time frames that we always do, that concept of time that we're always using constantly to kind of help us dictate what's going on. So when you're using these trigger points, you're using, like if you're scalping, you're using your most aggressive trends, right? If you're doing position trading, you're doing your most, or sorry, if you're doing position trading, you're using your most your longest legacy trends. If you're scalping, you're using your most interior pieces. And if you're swing trading, you're using the in-between that dictates the moment from swing trade to position trade. So the great thing about these trigger points is that it allows you to procedurally trade appropriately, right? So if you're, we're going to do an example for this. So if you're in this moment here and you say, okay, here's the hold level right here. Once this breaks, this move is going to gap up. We've got our swing low here. We've got a distribution candle. Okay, we're right there. Great. You can just simply exit this trade once this trend breaks, and you have a polarized moment that's going to gap you up to the next level, which it does. And once that breaks, you can simply.
So I think this is a neat trick where you do have local, global, legacy shields in the move like this, where you have 4-hour levels or whatever time frames you can justify in here, and you can use a local trend like this as a trigger point if your profits haven't been taken. So I think as trades go on, you can have your target up top, and then you can have your trends that are more aggressive and more aggressive and more aggressive as trigger points with re-entry points. I think that's one of the really big hidden benefits of local, global legacy trends, is that a legacy trend, a trigger point, it can be diminished down to the local point, which exposes you to the most targets between hitting your target and triggering out of the trade below. So ultimately you want to hit your target up here. That's great. But you can use this as, if target has not been reached, you use your most localized trend as your trigger point. I like using that as a trigger point because it locks up the most amount of profits in a trade. If you're using your legacy as a trigger, you're likely going to hit back some of the level that has supported you in the past, right? And then you're just kind of missing an opportunity to take another trade on it.
Get out of the trade, right? Now it's going to have to break on a time frame that you can justify, right? Like you could have gotten out there in profits. You could get out here in profits. But again, we're not going to sift through moves today to find hold levels and time frames, more so about the trigger points in the moves, right? So no matter what trade you're in, you're always going to have some type of trigger point in the move. You're either going to
a localized point is almost like the
scalp a trade. You're going to have a trigger point
giving up on a target
to swing trade or position trade. And this is a layer on top of hold levels, because we also have targets above, right? So if you go to a bigger time frame, I'm sure you're going to see targets above in here, or possibly 15-minute, some type of, you have one right here, and then you probably have a front side combination level there. Yeah, right here. Some kind of front side combination level right there, right? Like backside front, some kind of backside front side combination level that's still holding this thing down. And then you'd simply be in the next range, which would be here. Can't quite target that right there, or some other higher time frame right there, right? Just go back to the 15-minute candle here. That's fine. Or possibly trend, right? So this could also be a higher time frame backside right here, or trend, like I said. So again, trigger point from the top, right? So let's delete some of these levels here. We need that one. We need that one. We need that one. We don't need this, right? We don't need this. This is being broken right now. So we are fully expecting this to move down to its range, which is something like this, this range here, possibly even, right? And so it does, it goes right to this range, right? It goes right here, from here to here, exactly what we'd expect, giving us a new trigger point in this trade. So if we had entered, Did I miss one here? I think I missed one. Yeah, I guess I did miss one. No, that's okay. So if we had entered this hold level, we simply have a trigger point to get us out of the trade, right? So imagine you have your untested hold level right here. You have this one right here. It broke, it pulled.
So I think this is good to constantly adjust your trend, but realize that this trend is going to be constantly adjusting. So I think rather than creating a trigger point like this, you're just going to be, if you were in your trade down here, once you lose that trend, I think you're just going to be diminishing your profits and triggering out down to a point of lower and lower and lower hold levels on higher time frames. So when you the problem with using a trigger point like this, like an adapting trigger point, the problem with using an adapting trigger point is that, again, you just end up hitting the next hold level and you've lost another 50% of profits, and then you just adapt that. And when that one breaks, you just lose another 50%. So every time you kind of adapt this thing, you're just slowly bleeding away the profits that you've earned on a trade. So when you have these trigger points like this, you really need to define swing, scalp, and position trade and what it is you're trying to be in, because I think that instantly clears up a lot of, like, if you were down here and you're trying to be in a position trade, then fine, constantly trigger out and lock up only 1% of, if instead of 4 or whatever this ends up being, you can lock up just 1%. Actually, it's about 6% by the looks of it. 8,800 to 9,400 looks like what, 6? Oh no, 9,300 is up here. So it hit like what, 9,300. So you've got $500, 800. Yeah, you're talking about, yeah, you're probably about a 50% loss in each trade. Yeah, $400 would be a 5% spread. So you're somewhere around 5.x%. So you're losing like maybe a little more, maybe even 70% on a trade. If you're trading 100x, of course, you're losing every time you break one of these trigger points and you're in a position from down here, you're simply losing another 70%, 80% just to adapt the trend. So what's the point? So if you're going to turn this into a position trade, allow those triggers to break and have a shield below. If you're trying to lock up profits by constantly adapting your trigger point, like, you're just going to be bleeding out this whole time because it's eventually going to decycle its trends down to a hold level. So it doesn't really make sense to use a trigger point on a larger time frame like this for what should have been a scalp trade to begin with.
Polarize you right to the next one. Perfectly fine. Gap to gap, right? We know about this already. And just like this one will gap to this one here, and then even down to here, right? So gap to gap to gap to gap. And we draw trend based on that being hit, which brings us to moving our actual level to right here. So you have your final hold level in the move, you have your trigger point in this move that's going to break down, right? So you could simply be in this trade, like an example of a trade here. You could be in this trade saying, oh, I have a trend breaking here and I have a trend breaking here. Okay, I've entered here, so I'm safeguarded in either way. I've entered long here. If we lose this trend, I'm going to exit because I know I'm going to gap down to this range here, and I'm going to go like this, and I'm going to pull up my trend like so to here, and then I'm going to just recreate that whole same scenario where you hit the level, you're going to give yourself a final hold level, polarizes the moment, and gaps you to the next untested hold. So then you can do it 1, 2, 3, 4, 5 times, and you can just be sitting in this trade. And if you're so astute that it's going to go long, you could just play every single hold level and use trigger points as exits, right? So we're just going to sit here. Yeah, great. Oh, and that's where we are right now. Oh, so we haven't even exited this trade yet. We could possibly just be in this trade still and just be using this trigger point to exit the trade. Oh, it's actually perfect timing. It's actually current. That's great. So you could just use this as an exit on your trade. And if you don't have an exit, you simply have a target on the other side. Like, here's a target right here. There's the back side. So you know, your trade became from here to exactly this. So you made your 1.2%, right? And it's perfect. And now you're going to be re-entering down. This was tested. This was tested. Polarized now from here to there, right? So you're polarized from 91.61 to 90.60. So there's kind of this $100 polarity point. So when you took this trade and you have this hold level here and you're buying long here, you can simply stay in it till your trend breaks. Now, you don't have to. You have targets on either side. Just like this could have been a target right here, right? This is the hold level holding it down. This could have been a target right here. And you could have re-entered then on this one right here. So you could have re-entered here. You could have targeted there. Targets and trigger points. And it's the way in which we can decide where we want to take exits and profits in a trade, you always kind of start this thing. Like I'm going to go back to a higher time frame here, maybe just the hourly for this. You're going to go to a higher time frame and you're going to design what's happening in the move with your bigger trigger points, which are also trends, right? Because once this trend breaks, it's going to be a trigger point for other shorts to exit, right? So shorts who are setting up here, you're simply going to use this trend to exit. So that moment, it could possibly just continue to do this.
So if you're going to look at this in the same regard as you're looking at it on the bottom, why would you not have that same, looking at the top side of the chart? So if you were in a short from where these red scribbles are here, and you had now a global trend that went down like that, right? So you had a global trend that went down like that. Why not use that global trend as the trigger to re-enter this trigger point here, which is the hold level, right? So it's kind of like the same thing. If this target is missed, like you have this level down here, if your target was missed because it's somewhere down here, then why not have, like, obviously this is legacy up here, this is global here, this is local, and then you can even have an even more localized trend like that, right? Like from this point here like that. So when you're down here, you could use that as a trigger out of your short, and you would be in a much better position than letting this thing constantly cycle against the larger trend. Although your choice now becomes, do you want to lock up more profits because a target was missed on the bottom? And that's like a really great thing. Again, you miss a target on the bottom, and with trigger points, you can use our most localized trends to dictate if that target is still going to be hit. And then you can measure the gap between, because obviously, the gap from where this trend breaks right here, like this trend that would be going like that, where it breaks right here, the gap up to where this next trend would be created off of this hold level, or even to this, is huge. So like you're just bleeding away profits as this thing cycles in the other direction. So that's like really smart when you have target, trigger point locally out of a trade like that, is really, really smart.
Who knows how long? It could be down.
I think you're going to constantly see that happening on trades where you miss targets and then you can trigger out on the most localized trend.
To here, right? Like that's how you trigger an exit point, right? Like you could just stay in this trend perpetually until it breaks, just like you could do it right now on a local time frame. You could just, the more local, the smaller the targets. The more exterior, the bigger the profits and the bigger the targets, right? So you're using these larger trends to dictate where this thing could possibly go. So again, you could alternatively, we could have entered that long until from this moment here, whatever this hold level is here, we could find ourselves all the way, like, just theoretically, you could be here, $12,000. As long as that trend doesn't break, you're still moving against it. But the moment that trend breaks, you just use it as a trigger point to exit the trade. You have a target above. So you could use this trend theoretically and say, oh, my exit is here. This is my target is 97. Like, where's my profit cap? You use your trigger point to take you to your profit cap. So you either exit at your profit cap, which you've defined as a profit cap, or you simply stay in the trade on your trigger point, right? Your actual trend, right? So it just triggers the exit of your trade, and why I call it trigger points, right? So let's go back in here, take a look, see what's happening right now in this move. What are we looking at? 15-minute, 5-minute, and obviously this one is gone. We don't need that anymore. This was for, oops. This was for right here. This range is already tested, so you're somewhere around here in this, possibly even on this. But anyways, your trade exists here, not in this moment right now. Your trade exists here, right? Alternatively, you could use trigger points as entries as well, right? Like you could say, oh, here's a trigger point, identify the trend. That's also a trigger point for entries, right? Like you could enter on that trend and just exit on the lower trigger point, right? Like you could enter on this trend break, exit on this trend break. It's a little riskier for obvious reasons because you could just use this trend right here, this stops it right there, and then it breaks down, right? So it's a little riskier, but also, it's why we buy hold levels and not trends, right? Trends are more exits for trades, as to where hold levels are entries. They're perfect entries because hold levels are very easy to find, right? Like polarized moments, they're not so easy to understand and not so easy to find, but polarization exists, and a trend is polarization too, right? Like a trigger point will say, okay, this is moving up. We just broke a trend. We're moving up. But that's, I think, where people get it wrong, is that trends are exits, not entries. People try to buy trend breaks. Trend breaks are exits. So think about it for a second. If you're in a short from here right? So if you're in a short from here, this trend break is an exit for your short. It's not an entry for a long. An entry for a long is here, and the exit for the long is here, right? It's people have it confused. People have it the wrong way. They buy trend breaks. The trend break should be an exit, not an entry. All right, we're talking about very advanced trading here. We should already be in that trade if a trend is breaking. If this trend is breaking through, if that trend there is breaking through forward, we should already be in from a hold level before with a trigger point that defines where we exited in profits, and that trade simply is just still open until our trigger is released. Let's delete some of these brush marks here, and I'll show you guys what I mean. Okay, we're going to delete a few lines here just to make this a little clearer. We're going to delete this. This one we can leave on. Maybe we don't need this one anymore. We can just move that to, we can just delete it completely, because that's, you know, if we lose this and move in here, we're going to go down to here. So just to clean up this example, if we are long from down here, we exit that long when we break this trend, right? If you haven't hit your target. So that's key. Like if you haven't hit your target, right? Or whatever you've decided your target is, wherever you've profit capped this thing based on time frames to say, okay, we've made, you know, 4% is the possibility here. We're only at 1%. Let's not exit. Let's use our trigger and let's stay in the trade, right? Like you hit your target, or you trigger your trade out. So you've entered here long. You exit this trade when this trend breaks. You don't enter a new short here. Your short should be entered from here, right? Or wherever your hold level is on the top side. So that's where people get it wrong. You don't enter trends. You're just entering higher than you need to, because there's always a better entry than trend. So trend is a defective entry, because trend is meant to hold. So people who buy trend breaks, these are trigger points for exits. Right. Now, you can buy trend breaks. That's fine. But if you're buying a trend break, you should have seen it earlier and said, oh, well, this hold level is going to try to attack it. I should enter there. The difference between entering here versus here is how much? An extra 1%. Boy, that's a lot of flexibility in a trade to have. An extra 1%, an extra 100% on a 100x contract. That's a lot of flexibility to have, because all of a sudden, where's your liquidation against? Like, okay, let's do the opposite. Let's say we, and we're going to delete brush strokes here for a second. 1, 2, 3. Say we do want to buy this trend break, right? Well, we should do it on a hold level. We should do it here. So we're going to go here and buy that trend break like that. Okay. Where's your liquidation if you enter here? Let's measure it.
So this would be a nice part of the trade to say that, hey, if this trend is going to break, it's going to break off this hold level. So if you were going to enter trend here, like a really good entry would be on the hold level that can hold it adjacent to the trend. So if you're trying to buy trend break here, you're just buying it at the hold level, right?
Boy, you're getting close to liquidated where this move should be holding, right? Holy crap.
Or even down on trend. However, where you can hit a reverse or a ladder point.
In profits, you know, you're exiting in profits because you're still up based on your trigger point 40%. You're still up based on this trigger point 40%. So the difference between trying to buy a trend break versus buying the hold level is liquidation. It's quite simple as that, right? It's liquidation. There is no there's no in between. Get rid of this. Get rid of this. Right? So where could be some possible entries? So fine, you enter here, and let's say 9.3 is your trade. Great, you made 1.46%. If you used your trigger point, you made 2.5%. You made a full percent more. That's great, but that's not the key piece of information here. The key piece of information is if we're 100xing and we're going to get liquidated, if we enter here, we could possibly be getting liquidated by hitting this trend, this whole level down here, which could be what's breaking the trend up, right?
I agree.
Also exit in negative profits, right? So you enter this whole level here. If you're exiting your trigger, hey, 40% loss, as opposed to using this hold level and you made 30%, right? It's a difference between being somebody who's profitable constantly versus somebody who is profitable when things go their way, right? So profitable when things go your way, yeah, that's fantastic. But again, people get trends wrong. Trends aren't moments to buy breakouts. Hold levels break trends. Hold levels are the buys that we have in the trigger.
I think that's enough. The last minute here, I just talk about don't buy trends. So that's good. Let's go into a few examples on the chart. Oh, look at this. Like our move is trying to break. The hourly, what else did we define up here? Where's this thing actually going? I don't even know what you have, but you've broken your ladder point. Had the daily body, that daily body, which is also right here. So this is gone. We already broke that. Like that daily body is pretty close to being tested. Got a 4 hour here. Now, let's leave the daily body where it is and see what had happened here. You haven't tested this daily body. So really I want to be working down from kind of right here. This is where I want to start working down from. We can delete everything else. Get rid of that. We can get rid of this. We can delete everything else here. I'm not sure what this one is for. I think that was old information, old news. Was the 15-minute that you needed to create. See how it acts as that polarity because it has to hold that move. And then once it hits, it's jumping it up. So you can work down. So that daily was created here. So you could be anywhere all the way up to here, actually. You don't have to be. Backside holds. Well, you'd want to see off of this would give you here. So this one's already tested too, I'm assuming. So this would be a pretty good target for the 15. Okay, let's just leave that and talk about trigger points. This would be a decent target. Ladder's the move there, but you could also go a little higher here in the move. Okay, let's talk about trade management. So there's a really cool thing you can do. And so we talk about all these things, and now that we're breaking into trade management, there's a really cool thing you can do when you have a target. Say our daily was the target here, and say we just missed our marker. Say we're trying to trade here. So what you would do now, right, is you have your most localized parts of this trend as your trigger. So you have kind of this compression of trade exit between trigger points and targets reached or hit. So that was a bad example because we're blowing right through where we just said that we're going to hit. So let's pretend we never blew through that. Or let's say we just adjusted our target, right? Let's say we just got rid of this and adjusted our target. What is that? The daily body? Yeah, so you've got the daily body here. That's fine. I can create it. Now what you're going to do is you're going to use, maybe your blue was your target. Now you can start using localized pieces. Let's go to a 5-minute. Oh, come on, Trading View. Go to a 5-minute. Yep. Now you can use your most localized pieces as starting to create. If you missed your target, right, you can use this as your most localized piece to lock up profits. So, oh, we missed the 3, didn't we? We kind of skipped over the 3 here. I guess we need to check the 5 too. I'm not sure why I skipped time frames there. So you've got 5 to 5 in the lower time frame. That's fine. Got 3. Right. 3 to 3. So then that's going to end up being here, which will be like this. So say you've missed your target to your blue line and you've hit another level. This is where you can use a trigger because you can use trigger points, and then so fine, you can even use this one right here. If you break below this on the 1 minute, so if you don't bounce off this and move up, you can use that as a trigger point to lock up more profit. So you can think of missing a target. If you miss a target, you should be using your most interior trigger to lock up the most profits you can, instead of trying to wait in a trade and forego more and more and more and more. So if you have been moving up in a trade and you just missed your target here, your target was the blue line, you've just missed it, you need to use a more localized trend as a trigger point. You need to go here and say, okay, we've got a 3-minute to 3-minute, use a more localized trend as your trigger point, right? This is the shield to it right here. If you start hard closing this trend and the shield's not holding, you should get out because you're just going to lock up more profits every single time. See where this thing goes. You just hit your daily and now you're asking the question, can this range hold, right? Because you've already held this right here, or this, I guess this is the 1-minute hold right here. So now you need to hold this, which is this, or the backside. Obviously, if you hold the backside, that's good. And you develop a level over top of this, that's great, but you can go all the way down to here. So now your choice in locking up profits becomes trigger trend, lose shield, your choice. If you go for the ladder, which is losing the shield point, then you might be getting out here to hold this trend right here. So that's why you use your trend as your trigger point. If you hard close this in distribution, you can get out of the trade. So you can use that target missed with the compression of trends to trigger out of a trade, which is really helpful when you miss targets and you don't know what to do. A nice little trade management hack. Always constantly go back and check your time frames, right? Make sure there's not something that's being created that you're missing. You could use a range trend. I don't know how much I like it though. The range trend, yeah, you could use that. That would have been in existence first there. Well, no, it's not distribution. So you could use this if you wanted to play the trigger on the range. So you see how I'm defining different ranges based on different things. This is the move against the level. This is the range. There's the hold level. So you're creating different shields and triggers based on different parts of the trade, right? Like if you think the range is going to hold, create the range trigger. If you think the most sorry, my computer froze a bit there. If you think that the most local range is going to hold, create a range trigger. Computer's running super slow right now. Everything froze up for a second. Too much work going on in different things. Thank God my new computer's coming soon. So you can see how the attack of this level here, you don't have to wait for these exterior triggers to get you out, right? Like you can, if you're going to lose this range, you're going to go back down and test. So you can trigger out on a range trend. You can trigger out on a shield, which is the hold level. There's many things that you can trigger out on. I think you can also create the 5-minute range out here somewhere by testing that level and holding it. So that's another piece. Learning how to work with triggers is pretty important to when you miss trades, which I think is a big part of trading. When you miss your targets, it's like you constantly have a larger target. And when you miss your target, then you have to start justifying trigger points. You need to create this hold level to stay in the move. Otherwise, you're probably dropping trend to create the 5-minute. Like this is what I would be thinking right now. Okay, well, we need to kind of hit this create a hold level here. And if we don't create a hold level, then the next moment is going to be creating this 5-minute trend, interior trend from the bottom of this to that. I think that was where the 5-minute is. Yeah, from the bottom of this 5-minute to that hold level. So if that hold level holds, then we can create the 5-minute trend. And that will be our next trigger point. But right now, like what we have in this trade is that we have, hey, we need to hit this hold level. We need to create this. Is this tested? Kind of not. So I guess you could use this as a shield. If you hard close this level, you don't need to create the 5-minute range. So that would be your trigger point out of the trade, or what allows you to exit the trade. Let's kind of just talk through this trade. Okay, you're creating another hold level here now. So instead of that one, you're creating this. Let's check our other time frames. Do we have anything on the 3? We do. So now we're trying to actually create this on the 3, and the 3-minute has a whole 250 or 2 minutes and 50 seconds to create. So we don't really have that there. 5-minute level is too premature. It's too early in the trade. So you have this in 3 minutes that you need to create, or at a minimum this right now. Would I be looking for a short if trend breaks? No, I would be short from the level. The short is too. We're only talking about triggering out of the long here. You would have shorted the level. I don't think you should short the trend break here, because then you can hit this level and you create the 5-minute range. So you would either be exiting the trade now, or you'd be trying to create the 5-minute range. Like you've got 10 seconds here. You have 7 seconds to make a decision here, right? Like in 7 seconds, you should be making your decision. You shouldn't be waiting around to see. You make a decision now. I'm going to let the 5-minute range create, or I decide. This is a daily level. I think once it breaks this, you're going to be just like, you need to think about this trade differently. I think you can allow this range to give you the information it needs, right? Like I think hitting a daily level like this, I think you can allow this range. This is a pretty short range. You hadn't taken your profits here. What are you sacrificing at this point? You're already down 50%. So what would be, what are you trying to save? 20% more profits? Like that's not even realistic. Actually, it would have been here. It's like more like 15% profits. like 15% profits to see if this can develop a 5-minute range. That's what I'd be looking at. If that range can develop off this. Have anything lower. Well, you have a 3-minute hold here, but you really want to see it develop here. Really want to see it hold this. Or even this as a greedy ladder point would be pretty spicy too, because you could hit that. Technically, you'd be laddering the retest, so that would fire all things too. So I guess you have to mark both levels here. Otherwise, trigger out before you get down to your trend, because then your trend is likely not holding, right? So you're finding ways in the markets to lock up more and more and more profits. You're finding ways to have smarter trades. What did this hit? Did this hit the backside? No, it didn't hit the backside. So it hit this. You're finding smarter and smarter ways to allow you to stay in the trade longer before using a trend to trigger out. Because if you're using these trends down here, obviously you're giving up those profits. What you really want is a range to develop based logically off of what could happen here. Like this looks okay. It's trying to hold this level. It does look like it's going to go a little lower, but again, you could even be right here, which would encompass a ladder off of this test. So I would be looking for the 5-minute range to develop. So how much time do we have left on these time frames? We just created 3 minutes, so now we can get back over top of this. We can delete this. We can create the 5, which is up there indeed. So you can create that there. You're just trying to create criteria that allows you to better make decisions to stay in the trade longer while it's still in succession, but also lock up profits. Like that's the whole point of trade management, is being able to stay in trades longer and longer and longer by justifying the things that can happen. So this would be great. You could ladder off of this because it is laddering the move here. There are multiple points you can say here, and the lower you take, obviously, the more it diminishes to that range down there. But like this stuff holding here is going to develop succession for sure, while this down here might not be because it actually broke its interior range. Attack the daily, have succession off the local parts of the move, and you're like kind of in a good spot, right? But broke this. Hard closes this level, so there's no more untested levels. Now it's just a range. There's no more untested levels left. So let's be clear about that. This was an untested level in that moment. Now it's hard close an untested level. So you really have to develop some kind of move up. You either have to hold these as ladder points now, or you have to develop some kind of hold level here up. You really need to start closing over top of this. Otherwise, you don't have any untested hold levels left. You're just closing more and more time frames here. So now it's looking closer to an exit, right? Still be in the trade. You're still laddering the range, right? Haven't quite created that 5-minute yet, but now what you want to do is you want to create something like this here off of this test. How much time do you have left? You have 1 minute left. So if you can create that over the next 1 minute, you have your trigger out of the range, which is great because it's like very, very clear what you need to be doing here. We need this to hold for 1 more minute. If it can't hold this level, obviously you're not going to develop the range, right? So now you're creating that 5-minute criteria. So you're finding smarter and smarter ways to stay in this trade while taking the highest amount of profit. So this is how people have to think in the coming weeks when they're doing trade management and when they're trying to perfect these things. Okay, now we could be creating a 3-minute hold level. So this is good. We have a 3-minute range, but we also have actually just a 5-minute range happening in 20 seconds. So we might be actually creating the criteria here to stay in the move, right? Like we haven't triggered out yet. We've been talking about where we'd exit and not, but we're creating criteria that allows us to stay in this move. And this is how you have to manage your trades. You have to say, okay, I'm in a move. My target was missed, or I want to see if this is going like this. If you were in a swing trade, this is how you'd manage it. If you were in a scalp, you would say, oh, I missed my target. But a swing trade, you would always allow this to happen because you'd always want to see if the range is holding. So if this was actively a swing trade, then you'd always want to see. So now we've created the 5-minute level and it's having a little bit of, oh, no, the 5-minute is here. So now we need to actually move that to here. We can delete this. The 5-minute range is created. The 3-minute hold level is now trying to break above. So where do we close in 245? Does that allow us to stay in the trade, right? Okay, so this is good. 3-minute hold. 5-minute up here, break that, move up. That's of course, hold the range. Now you can trigger out of the range. Now you've got the perfect trigger out of the range. Oh, there you go. That thing just got yoinked down because it's trying to create that level, right? Well, somebody exited the trade, and you guys can see why somebody with a large position would have exited that trade in the snap of a finger. Remember how I talked about this has to create, and if it can't create, well, there you see institutional money just took a huge exit on this trade, and the move is broken. So now you can see how we were able to mesh with the best of them in this trade, in this trade, and you can see exactly where that big institutional money and where these big dumps and this real decisions, exactly where they're made from. Because this is everything we talked about today. Try to create the 3, and if you're struggling to create that hold level, bang, get out of the trade, because now it's too late now. And so this is like an awesome example, because now you can see firsthand how institutional people make decisions off of, I don't know how much Bitcoin dumps there. I have no volume on my chart because I just don't care about volume. It makes no difference to me, but I don't know, it looked pretty big. That looked like a few hundred Bitcoin minimum. So it moved down pretty quick. It was a pretty big snap, but you can see how it's justified now, which is super cool. It's super cool to see that. Or maybe a position hedged off of what was already along, they maybe re-hedged short. So it was 1,000 BTC. Yep. How cool was that to watch that in the moment, see that this 3-minute level being created was struggling, and then before it could create, bang, instantly it snaps it down. Right? That was like the coolest example I think I've ever done, because it was like literally inside the mind of institutional trading, because that's exactly what we always look at, is this kind of information, these kind of marquees, right? How cool is that? And so that's how you can develop the criteria to make decisions, right? Because you can see that decision was made before that moment happened. And that's what we aim for, is those preemptive decisions that happen faster than the TA, because the TA is reactive. We have to be proactive. We can't be reactive. We might as well trade with indicators if we're going to be reactive. But at least with TA, we can mark our levels properly. So this is kind of like trade management, but we're going to make a whole session out of this stuff and do it in the moment. Like this is just kind of like how I would be thinking through this trade in a logical sense. 1,000 BTC, that's unbelievable. 1,000. Great to watch, always amazing to see in the moment. Trade definition. Yep, it's getting defined in the moment, right? It's such a quick difference between creating this 3-minute level as a whole to support the range off of this 5-minute. So you guys can see how, guys and gals can see how we were trying to create a 5-minute range to allow this daily to break. And it is a daily level. So it doesn't surprise me that there's 1,000 Bitcoin there that exits a trade, because you know what? It is a daily level. Okay. You are hitting that daily level, which is pretty important. And you are trying to create a 5-minute range off of this, which is also important. Right. And then you're using things like 1-minute hold levels to create a 3-minute level, and it's trying to create that 3-minute level here. And you can see how it just kind of struggles a bit. And then a certain time period snap passes. They've defined their moment where they say, here's a 3-minute level. It needs to move above this. It was having trouble. And, knows, maybe they said, okay, well, at 20 seconds left in the candle, this is where we dump. At 25 seconds, this is where we dump. This is where we exit our trade. And they're not trying to dump the markets on purpose. They are protecting their account. They are protecting their long. They are using ranges and hold levels and the creation of these things to justify what makes sense moving forward. So we knew we had to get over the 3-minute level. It was also a 1-minute level in that moment. We had already laddered the move. The 1 minute was struggling to get over, and that's where a decision is made. So that's like so cool to see, because you saw what was looking like the 5-minute creation. You saw the level that you needed to get over, and you saw what happens when you can't get over that level. So it allows you to trigger out of a trade in a very good way. Yeah. And I mean, you're sitting there with your finger loaded on the button anyways, right? So really, really awesome to see. And now you're completely blowing all this out of the water, and you've got a new kind of definition happening in the trade. So whatever this level is here holding the move, you've got a new definition that lies here to here with different time frames activated, because this move simply has been in existence longer, right? You've got a 3-minute level here. I wonder if it's 5. Nope, 5 is down there. I wonder if there's a 5-minute backside anywhere that would be attacking a higher time frame, possibly. No to that one. 1 hour level. So if it continues to close over this hourly level, you're going to see that the development of smaller time frames off of this 3-minute loss targeting the 3-minute level. Remember what I said about inversion, and these moments happen against each other in inversion. You've got an hourly here. Do you have a 4-hour? No, you have an hourly here. So if this can use that 3-minute to develop, I don't know if it can. This looks like it's, ready to move down to the bottom of its range. More likely, looks like it's setting up a break of a move. But now you've got what has to close the hourly. You could even say this is an origin point, whatever this was attacking. So whatever broke out the move has to hold it up. So I would even go back further and do some definition work back here to see, okay, what broke this move out? So whatever this was testing in the past has to hold the move. So really, there's your point of what could be polarity against this, right? So that 3-minute level is like 3-minute attacks, 3-minute. But again, I just think it's still moving down. I don't really think this is enough to hold up the move. But what this looks like, it was maybe an origin level from the past that could have been being attacked and was the breakout point. And it's now failing that breakout point on the larger time frame, right? So you've really got all the information you need now as a trade management. So how cool was that? See, it's just going to be breaking down. Now you've taken trigger points, and instead of having trigger points as these outlying exterior moments, you can start working them inwards to find the smarter exits. Because if, remember, we're talking about if target was missed. Target wasn't missed here. Now, target for that 1,000 Bitcoin may have been way up higher, but this is a good enough reason to exit that trade when those things in the moment in the local range are breaking, right? So remember, this is how you have to trade when you're thinking about targets missed. So if you're thinking about, okay, I just missed my target, exit, this is the development you have to do, or the definition you have to make on your charts, the different defining points, or the definition that has to be filled in the moment, right? Comparative analysis 101. I guess it's not 101 because there's no such thing as comparative analysis outside of what I teach. But so I don't really know if 101 is the right term, but I think you guys understand what I'm saying. You have to use your information in the moment after to manage your trade, to make these logical decisions and say what's happening, what's developing on the chart. How do we analyze the architecture in the moment to see what could possibly come next? And if that is failing, then we're obviously in failure. As opposed to, you missed your target, you might as well stay in the trade. You're at your trigger point. This never existed. You might as well stay in the trade because this technically would be re-entry for a lot of people. So why are you getting out? Why would you get out here if this continues to hard close and hold? Well, you could have already gotten out up here, right? Because you have that heads up display of what's going on. Always a treat seeing the master in action. Thanks, man. That was great. Thanks, everyone. It's trade management. Like, this is where we're getting into a different realm of how these things are working, right? We're getting into a different realm of, like, you mark your technicals, and I think everybody realizes, but I'm just going to kind of repeat the process. You mark your technicals, right? Those give you your decision points. Your decision points allow you to say, here's a daily level. I should short or long, yes or no. Technical analysis just gives you your preliminary decision, okay? Your comparative analysis is what you use in the moment to go forward after you've entered a trade. So you combined trade management as an idea of what you are doing with comparative analysis to let you actually do it, to create things like ranges and trigger points higher and higher in the trade. So you use technical analysis to mark your points to make decisions. This is happening before a trade. You use comparative analysis once you've entered the trade. Like, this was a technical analysis point, data point. Are you entering the trade? Yes or no? If the answer is no, there's no comparative analysis to do. If the answer is yes, now you have to have a mastery of mental analysis, right? Because you're just marking levels on charts. Like, technical analysis is not overly complex once you understand it. It takes a long time to understand all of its deepest layers, but again, like, technical analysis allows us to enter the trade. Mental analysis allows us to keep calm and use our brain properly, right? Of course, this goes without saying. Like, mental analysis is critical here, because then if you're falling apart in these moments and you don't know what to do and things are moving too fast for you, then you need more mind training and you have like a mental analysis break in the armor. And then comparative analysis allows us to mark out all these things properly with the architecture given on our charts to make the decisions to say, okay, I'm in a trade long, I need to lock up more profits because this range that's trying to be created off this 3-minute holding is failing, because you can see as here, it's attempting to create that 3-minute level, just like we've been talking about all day, trying to create these levels. It's unable to create the level. The 5-minute, therefore, is collapsing. So if the 5-minute range can't create off the final hold level, we've got no hold levels left. The range can't create. It's struggling to gain the level it needs to gain. Yeah, okay, 3 candles later, it dumps. So there should be no surprise here. Like, this is just kind of like, what did you expect to happen, right? So now we use architecture to reduce the amount of money that we didn't take off of the target that was never hit. God, that sounds so weird. We use comparative analysis and trigger points to lock up more money while staying in the trade. That's maybe a smarter way to say it. In the trade management sessions, I'd like to learn more about what hold levels, right? To learn more about what hold levels to keep and which ones to deleting moving forward in the trade. I like to keep my charts as clean as possible for clarity. Oh, I couldn't agree with you more. Clarity and like chart dexterity, being able to move fast, and the clarity to be able to see only the most important information. Like these are two incredible things, right? Clarity and dexterity is really important. I agree. I like keeping my charts clean, and I think the way you do that, Joe, or at least the way you and everybody should be starting to think about that, is one of each level. One of each level. One 1 minute level, one 3 minute level, one 5 minute level. Like you could have marked this as the 3 minute level, and then you can say, what does it have to? And what you do is you say, okay, what does it have to hold or break? So this is a 5 and a 3. So you don't need anything over this. So this has to get over top of this level. Otherwise, it's inversing on the other side. It's also a 1 minute backside. So what it has to get over is this, but it also has to create the 3 minute on this side. So you have only the 2 moments that it really needs to create, right? It has the inverse level or the inversions, which actually can be here. So you have one in the same level. So it's like double polarity in the moment. So when you can't get past this level, like it's no surprise if this thing dumps down, right? And then now, if it's going to follow this trail of 1 minute levels, it's going to do it here. But it also hit a 5 minute level. So can you say that it can hit the 5 minute backside? You can. So you can be everywhere from here to there, depending on what it is, which will give you more definition moving forward. You could actually almost be even further in the range right here. Go to a 3 minute. I don't think you're going to have any 15 here. No. Well, actually, that if you get over that, you've actually created a 15-minute hold. So there's going to be a little bit of action here. But this is like kind of the perfect point, right? Because it's all of those inverse hold levels, and if it's the 5 minute, it's everything that you would need, right? So then it's just going to give you like your perfect. That would be the perfect target, by the way, to exit your trade. If you had missed this and you were still in the trade and you see this rejecting, that would be the perfect exit target, by the way. Because this can now develop what needs to move this thing down even further. So yeah, clarity, dexterity, one of each time frame, and mark only the things that need to happen, and then delete them. Like you see how I just deleted that 3 minute level, no longer relevant. Delete the things that aren't relevant anymore, right? Like this was supposed to be a 3 minute hold level that we needed to gain. I think it was right here. If you can't, oh no, it was right here. If you can't gain that, get out of the trade. Like get out and take it off your chart. It's not relevant for the future. Just the relevant information going forward, right? Just the relevant moves that actually have something going forward. Now you could say, okay, you could use this as a reverse. You could come back and test this as a reverse. You can delete this. If you start hard closing this, like maybe, right? You only need a few lines on your chart. You don't need this range anymore. Yeah, you only ever need what is next in the moment. So you've got the reverse level here against what looks like the micro range off of maybe reverse here, maybe this level here. I don't think I'd be taking a trade there, though. I think you'd be a little out of your mind to start longing against this trend this close to it. I think you'd need to at least release a few trigger points and allow these like this. Like think of this for a second. That 1,000 Bitcoin was maybe 500 long head short to 1,000, or maybe it was just 1,000 long. You need to allow your lower range to get hit. You need to release this trigger and hold the higher time frame now in order to get back up and attack this. Otherwise, I think you're just taking unnecessary risk. So if that's the scenario, then I think you need to go into a range like this. Like if you were going to take long to break this level, you sure as hell wouldn't be doing it here. So there's no longs, in my opinion, to take here. Maybe you have this. You have an hourly hold. Yeah, even better, you have this, which is still within the range of the attack on the daily. So you have an hourly hold here. Maybe this makes more sense to take as a trade. Possibly the 4 hour too. I think you can observe the 4 hour, and if it starts to hold, and I think if you're going to take this trend, this daily break here, you take it off of this, and you just allow your triggers to release, and then you just get back in on your trade based on, the smarter re-entries that will attack this level. That's very eye-opening. That's the live trade I needed to see. Thank you. You're welcome, man. And then even if you did short this, you can now create criteria here in the move going forward saying, okay, so I shorted this backside level up here, or whatever that 5 minute, I think it was a 5 minute was the body right here. It was pretty laser on, like you hit 5 minute body right here. What do you need to create right now to continue dumping this move, and what can hold it up? So that's the question I ask. I ask myself, what can hold it up? Trend can hold it up. Oh boy, this thing is slow. Like what can hold it up in here? That's what I ask. And when that starts to become true, if those moments hold it up, like I would say, okay, you've got a hold level right here. You've got trend down here. You've got this 5 minute reverse here. So you've got this right here. If these things start holding it, like, yeah, I don't know what this yellow line is, but we can get rid of it. 5 minute reverse right here, which could create like a little interior range. You've got this level here that needs to close under. So if you can't close this level, probably get out of a short because it might be moving up again. If you start holding one of these levels, like, then you can start to say, okay, well, if it holds this level, but it does it way out here, maybe it's a little 5 minute range from the bottom here to there. So then maybe you have a trend like this all the way out here. So if it hits this level all the way out here and holds that, then you've got a trend, and you now know what you need to like hold or break or whatever. Here's that 5 minute level was right here. Oops. There's that 1 minute level. Here's that 5 minute level was right there. Now that's holding it. It's laddering the move. Is that going to create a trend on the top side? Is that going to create a range trend? Like, what is that doing? So you have to mark, like, we really need to get under this level if we're in a short. And if we can, we need to stay in the trade because you've already laddered 5 minute to 5 minute and you've taken it. If you can't create that and you kind of linger around here for too long, like, you need to get out of a short because then you're failing to create a 5 minute hold level, like what it's doing right now. How many times has it attacked this already now? So now I would say, okay, like if we close above this, I need to get out of this trade because now you've like laddered the move, you're closing above this, you're refusing to lose that 5 minute hold level. So you've got a moment like this and you're saying, like, personally, I would still be in this trade. I would not be getting out. But this is your hold level that's trying to attack the creation of that 5. So what is it? Are you breaking up because a hold level is not able to hold you down, right? Or are you holding up on this level? Are you holding this hold level, which is the creation of the 5? Or is this inversing it down? So you always use kind of because the thing about this is this isn't in a long enough time frame right now. This isn't long enough to use anything else. We just attacked this up here, so we have to use the architecture and the moments that are here. And the first moments that happen that we can reliably use are a 3 minute next, then a 5 minute, then a 15. So we need to use those points, right? Oh, we're not able to create it. What about this? We're going to break over top of this. We're going to hard close this one because if we do, right? Or is this just still trying to create whatever trend attack it is, right? Where's the range trend on this side? You don't really have it yet because you got 5 there to there. You don't have it yet. Do you have a 3? You don't have a 3. Do you have a 1? No, you don't have any trends to hold you. So yeah, like, of course this is breaking up. It can't create the 5 minute levels, and it's holding the hold level, which is also the creation of the next level. So I think it's pretty straightforward that it will try to move up now. The only thing left that you have now is 5 minute right here. Hard close this. Is it laddering off something else? Is this creating the ladder point so we can create our first trend? What is it hitting? Right? Move quick and think. You've got stuff up here. It's not that. You've got this reverse level. It's not that. So it's not hitting reverses. Rather, it's just trying to close out this 5. 2 minutes. Two more minutes. If we start closing up here in 2 minutes, be aware that you're hard closing this 5 minute inverse here. So if you start closing above this blue line, we can get rid of this. We can get rid of, I don't know, I think we need this. Can keep this one. If you start hard closing above this blue line within the next 2 minutes, like in a minute and 40 seconds, if you're hard closed above this blue line, realize that you just hard closed your inverse level. Or you set up the candle that can hard close it in 5 minutes. So then you have to start, like, alarm bells have to go off. Now you're up here in the larger range. Now you have to pretty much reverse the daily. You can no longer rely on like 1 minute levels in here. Well, maybe you can, but holy crap, that would be pretty risky because what you're doing is in like a minute. Like, okay, fine. You could use a 1 minute level here, but that feels very risky. I don't think that's a trade I would take, regardless if this moves down or not. I don't really feel like that's a good trade to take there. Just because in 1 more minute you're hard closing this 5 minute level. So like if your price is above this blue line in 1 minute, you just created the criteria to create the next 5 minute hard close. But if you close down here, then you need 10 more minutes because 5 minutes you have to get back up over this level, and then you have to close the candle after that. So there's also things I'd be thinking about too. "40 seconds, what's it going to do?" You've got a decision to make here, right? Looks like it's going to create a candle that wouldn't potentially hard close that after already hitting the 1 minute and rejecting. Like I said, originally, I would go for the daily reverse if I even would go for the daily reverse. I don't think that 1 minute level is a smart short. It's too risky. Even if it executes and fine, sometimes those 1 minute levels will hold the move. It's just so risky. You need to create some kind of other development at this point that can justify this moving down. Otherwise, it's just going to keep going up. This is going to go further in the daily range and further, kind of what I was thinking earlier. It's just going to go further and deeper in the range. Like it's not done finding which part of the range it's going to attack. That was a good attempt. That was a cool attempt by that person and that 3-minute little move there. That was a cool attempt, but you know, I guess we're going to see. Now you've got the candidate to hard close this. Uh-oh. You have to do is hold this level. There's your hold level right there. It's the same thing as hard closing this 5-minute. Hold this, hard close that. It's all the same. You don't even need 2 lines. Yeah, not looking good. The 1-minute level is not smart. Hit this 5-minute level, and now it just laddered to this one. So this is protecting the entire move. It just laddered from 5-minute to 5-minute. Thought it was a 3-minute. I actually missed the fact that it was the 5-minute. I thought this was the 3-minute. I think it was the 3-minute, to be fair. No, it wasn't. It was the 5-minute. 5-minute was a deeper part of the range. It was a higher level that needs to be held. See, we missed something there. There's no 15. Actually, it does test the 15. And now it's closing over this 15. So see, we even missed more because we did, you know, I'm too busy explaining this stuff and not paying attention and looking. So we actually even missed more. We missed the fact that it was a 15-minute level. Okay, I'm going to eat. Breakfast has been ready for like over an hour. It's probably so cold. It's going to be bad soon. So thank you for the session, everyone, today. It was a great session, breaking into trade management and how to start thinking differently. Yeah, really eye-opening stuff when you start breaking into trade management. As always, it was a great session.